Welcome to Trading Technique Part 2. You may pause this video to read but understand that I'm not a financial advisor and that everything I do is for entertainment and educational purposes. In the next few hours, I'm going to explain 8 strategies that currently work in the stock market. There are 4 long strategies and 4 short strategies. Before we get started into the different strategies, there's a few things I need you to understand. If you have a small account, which is probably under 10,000, you want to focus on the long strategies. These plays have much more risk reward, and I found it's a little easier to grow your account. If you have a larger account above 30,000, you can work on the short strategies. I found to be better, safer, and higher winning percentage, but less reward. Going short requires a lot of risk control and experience, so control your emotion and make sure you don't let the stock get away from you. I suggest you take the time and learn both strategies so you will be able to understand the psychology involved with both of them. It will definitely make you a better trader overall. In the market, different strategies require different criteria. If the criteria does not meet or there is a part of strategy that is missing, it will affect the pattern's overall winning percentage. The best rule would be not trade at all. If all of your criteria is not met, however, I will leave that up to you. My hope is to give you a cookbook process. A cookbook process is generally step by step, and I hope I can convey my strategy in the same way. Volume bar. Consistent volume is when the stock has traded 1 to 5 million volume almost consistently every single day. Individual volume is when the stock has only few 10 million up volume spikes. Consistent volume will be a good indicator for short strategies. Individual volume will be used for both long and short strategies also. Here's some examples for XCO. As you can see, the stock has been trading 1 to 5 million volumes for every single day. 2 million volume, 1 million volume, 3 million volume, 5 million volume. And it doesn't really matter if it's a red candle or green candle as long as it's been trading for consistently monthly, yearly, or daily. Those are called consistently volume. Here's another example of CMLS. This one is not as obvious as the last one. This one also traded underneath 1 million volume. But as long as most of the candles are above 1 million to 5 million, that's considered to be consistent volume. For long strategies, there will be 4 different types of long strategies occurs in different time period. Pre-market breakout typically occurs around 9:30 to 11:30. Midday perk pattern is 11:30 to 2 p.m. Gap fill into close typically happens 2:30 to 4 o'clock. Multi-month or weekly breakouts happens anytime in the day. All of those strategies have high winning percentage, but there is a small percentage chance that you could lose, so always respect your risk level. Pre-market breakout. If you are trading part-time or full-time, you can choose which patterns you can focus on as your part-time or full-time. If you are part-time, I suggest to focus on pre-market breakout and gap fill into close. Those are the 2 high winning percentage patterns. You don't need much time to focus on the market all day. You only need to focus on pre-market breakout. The latest close around 11:30. Gap fill into close. Latest you can still get in after hour or after market close. So there's all the criteria for pre-market breakout. Step 1, you need to see the volume has to be over 100,000 before the market opens. So the stock has volumes before the market actually opens. So you can tell there's a bunch of eye on the stocks and the stock has potential movements. Pre-market percentage needs to be higher or precise between 20% to 50%, because if the stock is gapping up too high, there's not that much room for after market opens to push into. So typically pre-market breakout consolidating around 30 to 40%, maybe 25%, and there's about another 60% you can gain from, maybe even another 100%. So the higher it gap ups, the less the winning percentage. And the stock has to be on the first green day. Before you look at the stock is on the first green day, you have to see, and the stock has to be on the first green day. Let's look at the psychology of step 2. Long-term shareholders see a massive gap ups for a particular stocks, especially over 100%. They will more likely to begin to take their profits. By taking profits, it will cause stocks to drop. Buyers who bought the stock at the open will get taken out. Remember, some brokers don't allow people to trade during the pre-market. That's why people want to sell right after the market open. However, if a stock is only up 20 to 50%, they will typically wait for the stock spike a little bit more before selling their positions. So by waiting for more profits, buyer will have been long will not cause them panic of selling. Also, the stock is up 20 to 50%. Most buyers feel safe to buy the stocks. It will attract more buyers, and that causes the stock to have a better chance to spike. Low flow stocks, in case what I just described above, a better chance to breaking out. This is because lower flow has fewer shares to trade, and therefore the stock will spike significantly if demands increase rapidly. Always check the stock history and see if the stock have ever run in the past. This is how you judge if the stock can run multi-days or not. Be cautious if there is no history of the stock ever running. Stock typically can spike a lot intraday and might even go supernova. Clean charts are one of the best conditions for pre-market breakouts. Look and see if the stock has history of multiple spikes. However, observe how many days typically it runs, and that will give you an idea where to take profits. One of the most important things is that you have to check volume underneath the spike to judge how heavy the resistance is. There are around 10 failed spikes but small volume underneath. Then the stock is anything over 10 million resistance is not worth holding through the resistance. You want to sell the positions before short sellers comes in. Make sure you take profits before hitting the exact resistance. Also check out the fundamental as well. If the stock has warrants, never buy because it has a high possibility that the company will use news to make the stock spike up in the pre-market. And notice this is because this is one retail buyers to think the stock is going to spike while the company sells their warrants after the market opens. Step 4. In pre-market, stock has to look like a spike, then consolidation. If the stock starts to breaking out inside the pre-market, it generally has less possibilities of holding morning spikes. What we are looking for is a smooth consolidation and really clean breakout. It is better for the stock that we interested in trading and have a good news and to have other catalysts involved for us to even consider to trade. Although this might sound obvious, most people are too eager to trade. Patience is the key. Remember, in penny stock sectors, almost all of the stocks are completely worthless. As long as the stock has some kind of news, either it's an earnings winner or contract winners, it counts as a catalyst. Potential merge news for low flow small companies into large companies counts as a really good catalyst for a stock. Once all 5 criteria meets, the stock has the best possibility of breaking out to the new highs. There's typically 2 ways to enter a pre-market breakout. Once there's a consolidation breakout, I will size in within half of my positions. If the breakout holds and starts to spike more, I will typically add into another pullback to the full positions. The risk level will be where the stock broke out. If you think the stock is up too high in the pre-market, you can use first dip to get in. If there were previous support level from a long time frame, that would be ideal. If not, use intraday double bottom as your risk level also. To take profits, always follow the rules, sell into the strength, buy into the weakness. When the stock has further resistance, take profits before hit the resistance. If there is no resistance at all and you average 20% in profits, consider that to be a good trade. Once I make 20%, I will automatically take partial profits. It is very important to take profits because if the stock reverses on you, you don't want to lose all your gains. I normally leave other parts of my positions to run or take profits into the next spike. In here, I want to talk about something to keep in mind when you already learned all those patterns. It's something for you to not short. It's called slowly grinding, price neutralizing, factor conflicting. So those are the 3 factors that I want to give you examples for each one so you can know what I'm talking about and also to stay avoid when you are shorting. First, slowly grinding. So let's give a simple examples. If the stock was running a previous supernova before and start coming back down, now it hold this one half its own spike and starting consolidate for a while. Now, if the stock start perking up again, Yes, you can use either if the stock ran over here as you ran over before as a bounce, you can use this bounce as a bounce short. But if the stock has really small green day, small green day, small green day, and slowly grinding up in days, this is something to stay away from, because at any of these days, stock can be shorted from anybody using bounce short. But if the stock was running really slow, typically short sellers will really get frustrated and start covering their shares. Also, every single day has buyers. That means the stock has strength. Every single day, especially on those heavy volume traded supernova, every single day they have sellers. Most of the time, the stock has a lot of sellers. Typically in this supernova, has a supernova run before. So every single day will be sellers in there. But if every single day was green, they start grinding up into the resistance, means buyers are over sellers. That's a really bullish factor, because when the buyers can take over all the back orders from the resistance, that's a really bullish sign. So on those slowly grinding up by days, especially traded heavy volume before, and there's a really big potential for the stock to break out. And this is something I'm not suggesting short, because if the stock was here, so the stock basing is around here. So if you are using bounce short on the second green day, the maximum you can make is this range. And on the third day, maximum you can make is this range. The fourth day, maximum you can make is this range. But if you take a look of slowly grinding into smaller charts, now let's look at the fourth green day. So if the stock, let's give two charts right here. So this is the fourth green day. This is the third green day. And if the stock was slowly grinding up, pull back and finish, let's assume this is a random chart, finish on the third green day. And if tomorrow, if it bounces, if it keeps going, and the stock has a highly chance of landing into yesterday's support, because you don't know which support is going to land. It can land in the second green day support, it can land in the first green day support, it can land into this support. So there's not good enough risk reward, because if it's starting dipping down, and it can really likely to land into this third green day support, which typically around here is not good enough percentage for it to go risk the high to short into as a bounce short. So if it's a slowly grinding, there's too many support for it. It will be holding a stock really well most of the time. So I won't suggest you short into. I would like to short into massive parabolic, so there's no support whatsoever. You can have bigger and better risk reward. Now let's talk about price neutralizing. So when the prices start neutralizing, typically avoid the factor conflict. Now that's typically something to look for is the volume is fading. The price is not dropping. So when the price is not dropping and volume is fading, means most people are holding. And if your cover is not enough volume, or is not enough volatility, or not enough ask for you to cover into, then once you have a big short position, so your cover will boost the stock price up. So price neutralizing, let's give an example of DPW. So let's type DPW. Now, as you can see, the stock ran supernova before from 50 cents into $5. I've mentioned this multiple ways to play this chart before. And in this one day, the stock was in downtrending momentum. In this one day, stock has some kind of bad news and dropped all the way to the $2 area. And there's a huge dip by to where it begins. So that's a really bullish factor for a bearish stock. Once you can see there's bearish factor because the stock is downtrending, and there's bullish factor because there's a huge dip buy. Still at this point, the stock is overextended, bad news, and some downtrending. So the bearish factor overwhelms the bullish factor. But typically on those really trashy stocks, when they have this kind of huge dip by volume, typically means something. When it bounces to where they come from 3.31. So that's something really bullish, and had a really short squeeze into the close. So today, and the volume is not traded as much as these couple days. It's trading 70 million, it's trading 30 million shares. Today traded around 19 million shares. So when the stock was taking days to bounce into a certain range, that means the stock price is neutralizing. So it's gonna bounce back and forth between this $3 to $4 area. So if you are short or go long, that's not good enough risk reward because there's too much backorder overhead, there's too much dip buyers underneath. When the bullish factor and the bearish factor conflicted with each other and the volume is fading, that means the stock is neutralizing. I wouldn't touch it, long or short, because there's not enough risk reward on both sides. If the stock runs up to this most consolidation area, which is around 4.42, I might take a short because I typically don't like to short into slowly grinding up. I like to short into massive parabolic. So that's something to keep in mind. Let's back to the charts. Now, factor conflict, something to look for. Number one is bearish and bullish. They're in the same chart, and that equals no trade. Price neutralizing, volume lower, volume getting lower and lower. As a day trading, you want to focus on the volatility, and when the stock is neutralizing, it can't go up, it cannot go down, then there's not volatility. Once the volume is fading, there's not enough bid and ask, and you can't even get executed sometimes. So those are the factors to stay away from. In here, I want to show you how to build a watch list. At first, you want to keep it really simple, and the way I do it is I keep top percent gainers that traded with actual volume and put them on my scanner, or I put them on my screen to watch. And if the stock holds its gains for the rest of the day, or it can pull over overtake the gap down tomorrow, I will put them on my watch list and write it down, or save on my computer, or save on the stocks trade. And after you put every single tickers on your watch list, you do want to make plans ahead, and you want to give yourself a specific numbers before you pull the trigger. What does that mean? It means, for example, when you put XYZ on your watch list and you're expecting tomorrow, what happens if it do overextend the gap down? What happens if you do a second green day breakout? You do want to make plans for that. So you want to give yourself, okay, if the stock reaches to this specific point, where are you going to risk and where are you going to short, and what your size is supposed to be in. You want to make all the plans for potential stock is going to happen. What happens if it just dips straight down? You don't want to chase into the weakness. So you do want to make plans for all the tickers that you put on your watch list that you are going to potentially trade into the next day. And always you want the trade come to you. You don't want to force the trade by yourself, because when you are forcing the trade, you are typically chasing weakness or you are chasing strength. As the rule of making a consistently profitable trade, you want to give your best entry as possible, short into strength or buy into weakness. That's the two rules you have to focus on. And if you force your trade, you might break that rule very easily. So there's some ways to use chat rooms, but number one rule is never follow somebody's alerts, because if you follow somebody's alerts, that will just give you consistent loss, not consistently gain or consistently profitable. At beginning of my trading career, I always follow somebody's alerts, and that never went well. So because most people doesn't have a trading knowledge, they like to follow their guru alerts, and then some gurus will sell right after 3 seconds they bought it and make the stock to drop, and the guru made money but you didn't make money. So always make your decision on yourself. Sometimes there's really few times if you follow somebody's alerts you can make money, but most of the time you cannot make money from somebody's alerts. Keep that in mind and don't ever break that rule. Second, you want to see other people in the chat room are talking about, because as a day trader or as a part-time trader, you do want to see the stock that actually has volume. So volume, that's where the traders are interested about. So see what others are talking about and check out those tickers and put them into your own pattern. Every single of your pattern is supposed to have some kind of criteria to match for you to trade. So look up that ticker see if the ticker matches your criteria. If it doesn't, disregard. If it does, make a plan or put on your watch list for a potential trade. So that's how I use chat rooms. Don't ever follow somebody's alerts. Don't do that to see what people are talking about. Sometimes you might miss in some tickers other people are talking about. So when other people are talking about it, you can have a wide area to search through the tickers that match your criteria, and that will give you maximum opportunities for you to trade. And here's are some emotional circles you don't want us to be stuck in. I'll be personally in it, so I want you to stay away as much as possible. First is overtrading. So when you are trading a stock and the stock goes against you for 2 times, okay, you had the plan didn't work, and you got in again, and plan didn't work again. So typically for more than 2 times, you need to stop trading on this ticker. You can trade other tickers. I typically stop trading on the specific tickers because if this specific ticker starts frustrating me, the next thing you will do on the human nature is you want to get into a position that is a lot bigger than you're supposed to get in, and that will cause a big potential loss. So when a stock is frustrating you for 2 more times, you typically take a day off, or you don't trade the specific tickers, go for other opportunities. Typically that will make your mind fresh. That's how you stay not emotional for very, very long time. Second, after you take a big loss because you didn't stick to your rules and your plan and broke your discipline, that's something happens very, very usual, very, very often to every single trader. And this is something that you have to keep your mind straight and start fresh, because after you take a big loss, you will get really, really emotional. And the next thing you're gonna do is to go bigger and to make your money back or to cut even. And you are thinking about the reward side, not your maximum loss side. So if you go bigger, your position size get bigger, your reward get bigger, but what happens? You lose another big chunk of money, and you lose another big chunk of percentage of your account. So that's not very good for how to be consistently profitable, because if you are a trader, it only takes that 1 or 2 big losses to wipe out your entire gains for a month and years. So always stay disciplined, always have a maximum loss each trade. There's always opportunities that happens every single day, every single month. So market will be always there for you. You don't have to be rushed to make money. For every single field, if you're rushed to make money, you will fail, and your quality will not as good. In trading perspective, if you don't make a good quality trade, your outcome are likely to seem not as good. So after you take a big loss, if you want to make your money back really quick and you start going bigger on position size, if you lost, before back to irrational again, your account is probably down 50% of where you started. So those are the death circle you don't want to be stuck into. As a trader, put that on your wall or something to remind you every single day. Every single day is a fresh start, fresh opening. Don't let the past school with your head. Focus on the right opportunities, focus on the right patterns, and you will be consistently profitable. In this section, I'm going to talk about why do you need risk management. At first, you need to create a strategy that you can either you learn from your mentor or you notice by yourself. Second, you need to track the strategy to see if the strategy actually works in the market or not. So if you're using a strategy, putting down Excel sheets to track their performance. If they have really good performance and high winning percentage, you can put them as a sample together. And the more data you have, when you go into a trade with this specific pattern, the more confidence do you have, because you have something to back you up. The emotional aside, and you can fully focus on the trade. Number 4, the last, you need the correct risk management, because some of the time, why it's called a winning percentage? Because it doesn't work 100% of the time. So what happens if it reaches that 1 or 10% or 20% in that trade? And what happens consistently 4 or 5 times? Because you have a bad luck. So that's why you need risk management. Now let me give examples how to use correct risk management when you're a beginner. So first, I suggest you use specific amount of money that you can afford to lose. Either it's $500 or $50 or whatever you choose to risk for per trade. Then you take the winning percentage of the pattern and only trade that specific pattern for a long period of the time. So if the pattern has 70% of the chance to win, and every single time you're risking same amount of money, let's assume $1,000, and the reward is $200, or the reward can be less, can be one-on-one, or one-on-one, or one-on-two, or one-on-three. So the worst, it has to be one-on-one because you cannot go lower than that. So if you are risking $1,000, either you make $200 or you lose $200. Those two numbers either can be identical or this number has to be bigger than the negative. So either it can be 300 over 200. So the positive number cannot go lower than the negative number. Next point is, in theory, if you have a 70% win rate and you have a one-on-one risk-reward ratio, 10 of the time, 7 times you will win and you will make money in the long run. The next thing is how to calculate specific size into a trade. So after you have the strategy, you have the data, you have the correct risk-reward ratio, either it's one-on-one or the reward has to be above the risk. Next thing you need is to correct size and name. If you are shorting some kind of parabolic or higher low or lower high, or if you are buying into an uptrend, so if this is $2, this is 1.8. Now let's assume you're risking 20 cents and your maximum loss per trade, whatever you define is, your maximum loss is $100. So in this case, you have to go in with 500 shares. So if you lose that 20 cents is 500 times 0.2 equal 100. So that matches your maximum loss. And use 500 shares times $2 per share equal 1,000. So you're risking $1,000 and risking 20 cents to risk. Now, if the top is 3 and you're risking 20 cents on the $3 area, because the stock price is higher, the money you're invested in will be a lot bigger. So you use 500 shares. The same thing won't change. 500 shares times $3 per share. So you're actually investing $1,500 instead of $1,000. So different stock has different price, and you can use that specific. The higher the stock is, then you can actually invest more money into the higher price of stock and you still have the same amount of maximum loss. So I hope this is enough to explain, and let's go over on the long side. This is the short side. So same method, your maximum loss is $100. Now let's assume this is $1 and this is 1.2. Your entry level is 1.2 and you are risking $1, so you are risking 20 cents. Now same thing, it's 500 shares times 0.2. That's your maximum loss. Now if you are risking 20 cents on a $2 stock, so this is assuming this is a $2, this is 2.2, and you're still risking 20 cents, but your original investment will be a lot bigger. So the initial investment of that $1 stock is 500 shares times 1 equal 500. So you're investing $500 into this stock. But if the price is higher, you can use 500 times 2, you're investing $1,000 into the stock. So sometimes your investment amount can change, but you can still stay on the same maximum loss. So when the price is higher, you can actually invest more percentage of your account to have the same maximum loss in order to reach the maximum profit. Because the higher the dollar amount is, the more likely they're going to drop. So let's assume a penny stock, because the penny stock starts from really low. So you can go really high, go to $5, and the amount you can drop is to 2. If you cut your risk level really tight to the top, you can actually invest more money than the lower price stock. Also, in the lower price, you have to get a lot more shares than the higher price stock amount of fees to get those shares. So my comfortable range is between $1 to $10 most of the time, but anything under $1, just too many shares and the fees is not worth it. But if it's any range between 1 to 10, it's acceptable, but my most comfort zone is around $2 to $5. So at the end, there's 5 things you need. You need a strategy, you need to track the strategies, you need to figure out the strategy winning percentage, and you need a risk management, and you also need the correct position size to size it into your stock. Once you have the 5 things, and you can stay consistently profitable. In here, I want to give a clear example of pre-market breakout and what kind of criteria you need. It's a much simpler version. It's more clear, it's more simple. So if you give 9 charts. Now here's the pre-market, 9:30. You do pre-market consolidation, typically bouncing around back and forth around this range. After the market opens, volume dips down, and right after started breaking out this pre-market high, here's typically my 1/3 position size. Pullbacks at another 1/3 position size. Then started breaking out again, pullbacks, and start breaking out. Typically, there's going to be 3 pullbacks, 1, 2, 3, and I like to add into the first pullback if I'm late, if I didn't see it coming, and if I'm late, I like to add in the first pullback and take profits into the third push. So 1 push, second push, third push. So I like to take most of my profits, almost 2/3 of my profits over here, and let rest of 1/3 of my position size to run. If it goes higher, then it goes higher. If it start dropping, my average is supposed to be mostly around here, which is around about 1/2 of the spike. If the stock breaks this, comes back down and breaks this 1/2 of its own spike, that's where I'm going to get out. So when the stock comes back down and break its own 1/2 of its own spikes, that's considered to be really bearish. So break. So I wouldn't be holding my long positions if the morning spike didn't even hold 1/2 of its own gain. Now, for pre-market breakout, you do need all the bullish factors into your side. So first one, I would like to be as low flow as possible, and the lower the flow, if it requires high demand, the stock will spike faster and much more aggressively than other higher flow stocks. And I want 15 million market cap or lower, because make a 15 million stocks to go over 100%, you only need 15 million market cap to go over 100%. But if it's a 1 billion market cap, then you need $1 billion to invest into the specific morning to increase the stock on 100%. So that's really unlikely to happen. I would like to prefer low cap for pre-market breakout, because that's considered to be a bullish factor. So low flow, low market cap, and I also want some kind of catalyst. I believe all penny stocks are junk, but when they have some kind of good news and low flow, they will suddenly have a really big demand, and you can make 50-60% gains just by participating into the first green day spikes. So news and catalyst. Some news you need to be more focused on. If it's a merge news with a bigger company, that's a very bullish news for a low flow and low cap stocks. Now, if it's an earnings winner or contract winner, that's less bullish than the merge news, but it's still considered to be bullish. From a personal perspective, if anything that this company receives some kind of down payments from other company or other long-term investments, I would consider it to be bullish, because the company actually received funds other than just talk about their projects, what's going to happen. I like to see something's happening right now. So down payments, funds. 4, I want to see the stock has cleanest chart as possible. So for a longer term chart, let's assume the chart looks like this, and there's no big volume underneath that, over like 20 million volume or maybe 10 million volume. That considered to be some kind of resistance. The stock, if it's running around 200K, 300K, 200K, or maybe even 10K or 50K volume. If this morning in the pre-market already traded around 100K or 200K, that shows people have eyes on the stocks. There's very clean chart that the stock doesn't really have any resistance. So short sellers likes to short into heavy resistance, but if the stock doesn't have any resistance, there will be no short sellers. So that will give you another bullish factors. There's less shorters than the normal shorting into heavy resistance. So you need the clean chart as possible. No heavy 10 million resistance or 20 million volume resistance underneath any kind of price point. So for example, if you look at a 6-month chart, most of the time on penny stocks, you can see the stock has been traded before and they have a one big spike, and underneath the volume bar will be around 20 million to 40 million. That's considered to be already heavy resistance. And you can buy the pre-market, but I always suggest that you sell before hitting into that heavy resistance. But that's where the short seller is going to come in, and people are looking to take their profits will take profits before hitting the resistance. All the charts that went supernova, I would say bigger, 50 million resistance. Now, next time spikes, you use the bounce short, it will hit close to the high, but it didn't hit because that's short sellers like to short here and risking here. They like to use some kind of risk level to control their risk management. Now, next time bounces again, they will be using this high as a risk level to short into here. Now, that's why the supernova just bounced lower and lower and lower and lower, and the stock goes completely to junk because stock can never spike again. Every single time when the stock spikes, there's going to be people that doesn't know about volume and resistance, and they like to buy the stock is up. That's why they become backholders. Once the stock spikes again, they like to sell. That's where the backholders come from. That's how bounce short becomes a pattern. And that will be all for a pre-market breakout. If you want to track by your own, track the data to see typically how many pre-market pullback does it have. And for my statistics, you typically have only 2 pullbacks. Sometimes have the 3rd pullbacks and keep going, sometimes doesn't. So I like to take my saved profits over first strength, second strength, and on the most of the profits on the 3rd strength. So that will be all on the pre-market breakout. I hope it's understandable.
In here, I wanted to give some examples about pre-market breakout. And as you can see on the left side, before 9:30 market open, and the stock was consolidating between this 2.6 and 2.75 area. Typically, I want to see the stock was not up that much. So I would say definitely in the pre-market, it has to be under 50% for potential long. And right here, the stock was consolidating, I would say around 20 to 30%. One of the most clean chart is once you see the pre-market breakout and there's decent volume coming in, take out this pre-market consolidation, which is pre-market resistance. You can use this pre-market high as a risk to sizing into a trade. You can see the stock is a biotech. So when you see the biotech stocks, you don't really need to focus on the flow, just focus on the chart most of the time. When you see this big volume breakout, you can definitely size in and put it on the chart here. Once the pre-market resistance got taken out and there's no pullback, then I would size in around 1/3 in this breakout area. And if the stock keeps going and if there's a pullback, typically there's the first pullback, that's people who are late to the breakout and they want to get within the better entry. The breakout buyer will add in here and the dip buyer will add in here also. So I wouldn't say short sellers will come in to short this morning spike because if you see a clean chart, there will be no resistance. Before you look at the intraday chart, you have to look at the overall chart about 3 to 5 years to see if there's any hard resistance, hard individual resistance or consistent resistance before to judge if you should add into the pullback or not. So if the chart is clean, you can add more size into here, and you do want to take profits into the strength. Don't ever try to take profits at the top. If the stock goes higher than you expected, it goes higher than you expected. So you don't have the feeling of fear of missing out, because taking the profit into the green candle, into the strength, it's always the best exit that I found out for the past 2 years. So pre-market breakout, don't need to specifically focus on the flow or the market cap. I would say market cap under 100 million, it will be a good consider to buy the pre-market breakout. If the market cap is way too big, I would say if it's around 200 million, it's hard for stock to spike 100%, 60%. So if you can make a pre-market breakout,
in here, I also want to talk about COSN. This is not a biotech, but as you can see, the flow is really low. The market cap is tiny. Anything under 50 million considered to be small cap or micro cap. Same thing, same consolidation area around 1.75 to 2.1-ish. So before you buy a breakout, you do want to see a small range of consolidation, and the stock is not up in the air like 100% or 200% in the pre-market. Once you see this consolidation, you want to focus on buying the breakout of the high of the pre-market. So if you see in the morning come back down, you already had its own weakness. Typically when you want to buy a breakout, you want to see where's the bottom, where you want to risk at. So the open low was around 1.90. If you bought the breakout around 225, you will be risking 35 cents. If the stock already has its own bottom, had this really decent consolidation, I know there's kind of a range of support around that area, so you can be sure to pick a risk around the open price, which is around the 1.90 area. If you bought the breakout, it's the same thing. Don't ever try to get into a stock with your full position, always breaking into parts. So I would say 1/3 when the stock already broke out the pre-market high, comes back down. And right here, you don't want to add, but you can add a little bit, but you don't want to add too much because you want to see some kind of bullish sign. If a morning spike can hold 1/2 of its own spike, so which is around 230-ish, and you see a double bottom, which is bullish factor. So if the stock can hold 1/2 of its own spike, and you can see a double bottom, which is another bullish factor, you can take a decent entry and start to participate into this next breakout. Now, the next thing will become is in this area, the stock is keep holding that 2.5 area as the consolidation level. So right here, you do want to add because he never cracked this 2.5 consolidation area. And also you can see there's a small decent triangle and has lower high and lower high, but never can crack this support. When the stock start reversing and start breaking out, you can add into this breakout also and ride the stock into the parabolic, take either profits, sell into strength. Next thing is when you see the stock was going parabolic, very clean chart of this breakout going parabolic and massive pullback, always see the stock will have some kind of pullback, really big red candle. I would say if the red candle gets broken again, that's enough dip buyers to overcome this high selling pressure. Once you can take over that high selling pressure of that parabolic, the stock will become bullish again. That's for COSN. For this example CUR, this will be a perfect example for a pre-market breakout. Same thing, you see a morning consolidation and it's kind of weak, but you can see the clear range of bouncing back and forth in the pre-market. And once you start having a weak open, the stock, low market cap, really low flow. And once it's starting taking out the pre-market high of this 170 area, and it went to almost 240. But after you bought the breakout, either broke the open price or it broke the pre-market breakout, or break the pre-market high. Typically, I use one entry here in the pullback, another entry here, and after it completely broke out, I would chase a little bit on the green candle and sell into the strength. Most of the time, you basically take into strength, but at this point, as you can see, the stock had a large gap between this one to the lowest gap is 247, and that's exactly the point people are looking to sell, because there's a strategy called the gap fill. Once the gap gets filled, and the stock likes to drop again, so that's why most of the people sold around this 240, or people are shorting around 240, and that's double of the selling power. That's why the stock came down. And stock consolidated for the rest of the day and looks really weak in the afternoon. I wouldn't suggest shorting to the first green day. I would never suggest shorting to the first green day. So if you see it's weak and it's heading into this 1.9 support, I still wouldn't buy it until this 2.47 completely broke, and it's a confirmed breakout, late afternoon breakout. I will take a small entry, because afternoon buying the breakout is not as good to buy in the morning breakout, because typically in the morning it's a straight out of buyers heading into of this emotional buy, but typically in the afternoon most people are emotional squeeze. So you don't know how many shorts is in the stock. Once you start squeezing, once the shorts get exhausted, that will be a huge instant drop of whatever the highest of squeezing point. So afternoon breakout, I size it a little bit smaller than the morning breakout. And that's typically what I do for the afternoon and morning breakout. So this probably will gap up tomorrow, and you can use this 2.49 as your support to play out this stock. But if tomorrow gaps down, you can also use overextend gap down strategy to take advantage of buyers and short sellers.
Same thing on ECYT. This is a biotech stock, but when you are trading a biotech stock, you don't really care about what's the flow, what's the market cap. You want to focus on the clean chart. So if you see the pre-market gap up and start consolidating 20 to 30%, and once that breakout happens, you take 1/3 positions, add into pullbacks, sell into strength, add into pullback, sell into strength. So in here, it doesn't really matter where you want to take your profits, but always take the profits on the green candle. At first, when you are trading this in real time, you don't know the stock is going to go to $5. When you bought the breakout and you anticipate into the breakout, you can always add and take profits into the strength. Never take profits into weakness. So add into weakness, sell into strength. As you are taking the profits along the strength along the way, and you want to look for some kind of a hardcore pullback, some kind of hardcore big pullback. And as you can see right here, it dropped from 3 all the way to this 2.4 area, and the stock didn't tank from there. It actually, there's big dip buyers comes in and start dip buying and put enough buying pressure to cover this massive panic. So once that $3 area breaks again, that's a really bullish signal, because most people, when they see this massive panic, the first reaction is they will sell. You can kind of imagine if the stock has everybody selling the stock, and if the stock re-breaks that high again, that's how many people that bought in when those people sold into them. So you can kind of imagine how many people actually bought into that dip. You also can get a kind of signal is there's about 600K volume bar sold into that candle, and there's a 700K candle bought it right back. So typically when you see a signal of dip buying, is you can kind of see the volume bar. The green volume bar is a lot higher than the panic sell red bar. And once that, this is one signal, but once that breakout happens, break that $3 area, that's the second signal of you to either you can dip by 1/3 of your shares in here and add 1/3 when the stock will start intruding, break out that $3 area, and you can take profits on the strength again. Pre-market breakout, something is break the pre-market consolidation, but this panic breakout is you have to focus on the volume bar underneath, and you can have to imagine if the stock has had a massive panic and in really short amount of time the stock recovers again. That's a really bullish. Same thing on ECYT. This is a biotech stock, but when you are trading a biotech stock, you don't really care about what's the flow, what's the market cap. You want to focus on the clean chart. So if you see the pre-market gap up and start consolidating 20 to 30%, and once that breakout happens, you take 1/3 positions, add into pullbacks, sell into strength, add into pullback, sell into strength. So in here, it doesn't really matter where you want to take your profits, but always take the profits on the green candle. At first, when you are trading this in real time, you don't know the stock is going to go to $5. When you bought the breakout and you anticipate into the breakout, you can always add and take profits into the strength. Never take profits into weakness. So add into weakness, sell into strength. As you are taking the profits along the strength, along the way, and you want to look for some kind of a hardcore pullback, some kind of hardcore big pullback. And as you can see right here, it dropped from 3 all the way to this 2.4 area, and the stock didn't tank from there. It actually, there's big dip buyers comes in and start dip buying and put enough buying pressure to cover this massive panic. So once that $3 area breaks again, that's a really bullish signal, because most people, when they see this massive panic, the first reaction is they will sell. You can kind of imagine if the stock has everybody selling the stock, and if the stock re-breaks that high again, that's how many people that bought in when those people sold into them. So you can kind of imagine how many people actually bought into that dip. You also can get a kind of signal is there's about 600K volume bar sold into that candle, and there's a 700K candle bought it right back. So typically when you see a signal of dip buying, is you can kind of see the volume bar. The green volume bar is a lot higher than the panic sell red bar, and once that, this is one signal, but once that breakout happens, break that $3 area, that's the second signal of you to either you can dip by 1/3 of your shares in here and add 1/3 when the stock will start intruding, break out that $3 area, and you can take profits on the strength again. Pre-market breakout, something is break the pre-market consolidation, but this panic breakout is you have to focus on the volume bar underneath, and you can have to imagine if the stock has had a massive panic and in really short amount of time the stock recovers again. That's a really bullish.
The second pattern will be called midday perk pattern. Now, most of the time, a midday perk pattern happens around, I would say, 11 o'clock, 2 o'clock in PM. And this is when you trade around midday, but typically I sizing in the midday really small, because most of the time midday is really unpredictable, except only this one pattern that happens likely to work. They have less odds than pre-market breakout, because midday is typically 50-50%, but this pattern works around 60 to 65% of the time, and this is how it works. So you have the pre-market around 9:30 area, and you did some kind of breakout in the morning, and if you think you are late to the spikes and you see this big pullback. Here is the open price. Here's 1/2 of its own spike. Now the stock goes up and comes back down and start consolidating for like an hour or two. First, the couple criteria the stock needs is the stock has to be already trading a huge amount of volume. Typically around this before hitting 11 o'clock, I would say at least 5 million or plus volume that is needed for this pattern to work. And the stock has some kind of big catalyst. Either it's a biotech phase 1, phase 2 news or contract winner. Third, stock holds 1/2 of its morning spike, which is around to where I'm drawing level or above. So 1/2 of its own spike. Also, what you need is the stock has to be above the open price. So because you want to put as many bullish factors on your side to increase the pattern winning percentage. That's what you need for all of the either long or short. So the fifth, you need, of course, low float, low market cap. Those are always needed if you're going long because that will increase your winning percentage because it's a low float and low market cap. Step 6 is the stock has to consolidating for at least 1 or 2 hours. So for this consolidating level has to be at least 1 or 2 hours, and you can clearly see there's a bottom or there's a clear support around that area. And what you need to notice in real time is consolidation level and start perks up again. And you can use this consolidation level as your risk or some kind of basing. So if you are, let's assume, give a stock a price, this is $2, this is 1.5, and if stock perks up to 1.7, I will size my positions there a little bit, but typically I size in midday perk pattern a little bit smaller than other pre-market breakout or bounce short or other patterns because I don't like to trade in the midday. That's why I size in a little bit smaller. But if I see a really good patterns, I will still be trading it, but sizing will be a little bit smaller than usual. So I'll be sizing in this 1.7 area, risking this 1.5. Now, if the stock keeps spiking, if the stock goes back down, I lose 20 cents, which is 2-3% of my original position size. I don't really, to go into a stock market, you have to be afford to lose. So always respect your risk management, always respect your risk level. So if it goes down, it goes down, I lose. If it goes up, I will have higher good risk reward because stock has, also you need a clean chart also, forgot about that. I already mentioned what's a clean chart in the pre-market breakout. So if the stock starting breaking out again, if you're using this 1.5 area, risking 20 cents, and if the stock goes up, and I typically take partial profits here because you don't know either it's a double top or it's a breakout. So I take partial profits when they reach to this $2 area. If it pulls back, I wouldn't be selling over there. I don't like to sell into weakness. And if it's starting forming a cup handle, and I will add when the stock starting breaking out this too. So I will take partial profits because I don't know if it's a double top or a breakout, or it can fail straight from there. So at least I took some of my profits. And if it's starting forming a cup handle, I will add into this breakout point and write in my profits into the strength and take profits into the strength. Same thing, way to take your profits to either to see if there is resistance in the previous history, or you can just take your average gain. Typically you want to track your trades, you want to see what's your maximum average gain. So if your maximum average gain is 20% or like 30%, maybe even 50%, choose the average. If it's around 35, you want, so if it reaches your maximum average gain, I typically take my profits off there. And if it didn't reach there, if it starts showing weakness, I'll just take profits. You always want to take profit into strength, but if it shows weakness random places and start going down and start losing momentum, always use 1/2 of the spike as your momentum shift. So in this case, if the stock breakout of this $2 area and spike, let's say spike to $3, this spike is $1. So if it goes down over 2.5, I will take all my profits from there. So this here is 1/2 of the spike. And that's how midday perk pattern work, and much a simple version. Here's how pattern works. So KTOV is a biotech. If a biotech has a low flow and a low market cap, that's even better for buyers. That also increases the winning percentage of going long in this specific stock. And on KTOV, the stock, you can see around before 11 in the midday, and once it starts perking around, breaking out this 2.15 area, you can use that the high of the consolidation as your risk, sizing into there, and if you can add into the pullback, once the stock starts going parabolic, you can sell into the strength. But when the stock comes back down, you will be selling almost all your shares. If you have shares left, your average will be very decent. And if you add it around in this weakness, first you don't know it's going to be consolidation and start taking a secondary breakout. But if you want to add into weakness and the stock didn't break your ultimate risk, because first there will be a support right around where you bought the breakout, and if you add it around here, your average will be around 2.25 and you're risking this 2.13 again. So that will be a very, very close risk for you to risk for. If it starts consolidating, that will be even better, because as a short sellers, you want to think some kind of, you don't want to short into support. Also, you don't want to short into this double support. If the support are really close to each other, 2.12, and here's another support around 2.37-ish, those two support are only 15 cents of the gap. So if the panic comes in, it has to break two support at the same time before it cracks further. People like to dip buy into support, and if there's two support, there's going to be two different streams of dip buy into support. And short seller doesn't want that kind of stacking support everywhere. If the stock consolidating again, my averages will be around 230, 225. I will be anticipate into the secondary breakout, so I will add into this breakout using the high of this breakout level as my risk again. So if the stock goes parabolic, I will take profits into the strength. That's something to keep in mind. And if the parabolic, the top was way off, it's way high compared to where the support is, the stock is going to come back and dip down before respec again. So there's no support near around this $3-ish level. So that's why I will be taking profits into the parabolic, because once the selling comes in, I have no support to risk for. Around here, I will be taking all my profits on KTOV in this specific stock. So that's for KTOV. Here I also want to give some examples about midday pattern. This pattern specifically works on the first green day of a stock have some kind of catalyst. Doesn't really matter what the catalyst is, as long as it's a good catalyst, it will be considered some kind of catalyst. Midday perk pattern typically happens around 11 o'clock to 2 p.m. And in the entire trading time between 9:30 to 4 p.m., most day traders like to take their profits before the day ends. So be really careful. Don't trade around after 2:30 p.m. if you are a long stock. You do want to sell around in the midday or before 2:30 p.m. So if you want to run overnight, you do want to see what the stock reaction is between 3:30 to 4 p.m. right before close, so you can have some kind of judgment if the stock finished really strong or weak. In this AMMA chart, as you can see, the flow is around 10 million, which is considered to be a low flow. Market cap is around 34.8 million, which is under 50 million, so a small cap or micro cap. In midday perk pattern, you always want to see some kind of morning spike and comes right back down and start consolidating in the midday, and it sets a higher low and higher low and a higher low, and once it start cracking that, once you start breaking that critical points, the stock will have a massive spike again. So in this midday perk pattern, you do want to have several entries and several exit. Massive morning spike in the morning, comes back down and had its higher low, higher low, higher low. You can use this dip on the red candle as your ultimate risk. Typically, when the stock can hold one half of its own spike, considered to be a bullish on the first green day. So if you use that as your ultimate risk, if the stock start breaking the day highs, you do want to take profits right around this time, because when you are trading stock in real time, you don't know the stock will be breaking out or will be just set a double top and start dropping there. So on the regular trading day, if I see this kind of pattern, I will take half of my profits because I don't want to go guess if it's going to be a double top or it's going to be a breakout. So if I lock my profits, 50% of my profits, and I would just let the other 50% of my shares just go and sell something into the strength. But if it's a double top, I'll be totally okay with it because I already took my profits. I already took advantage of this pattern. But if it's a breakout, that will be even better. I will sell the stock into the strength and I will have more profits than the double top right around this line. So that will be for AMMA. This is another midday perk pattern. As I said, in this case, the market cap is pretty high and the flow is pretty high. That decreases the stock winning percentage, but this is one of the perfect midday perk pattern. If the stock doesn't reach the criteria you're expecting, and it's pulling out that the same patterns, I typically want to go smaller than I used to. So if the stock matches the maximum criteria, that's the full position. If it misses one criteria, that's half of the positions. So practice and track your data. Some tickers doesn't match the whole criteria. Some tickers miss one or two criteria. You have to figure out the difference. Managing your position size according to the criteria is very, very important. In this case, the stock did pull out a midday perk pattern, break out that 2.5 area, went all the way to 3.5. That is 30% of the profits. And track your average gains and losses. If you don't see the resistance ahead, always take all your profits around your average gain. Not considered to be a good trade. Sell into strength and take your profits into the average gain. Sometimes midday perk patterns are unlikely to hold its entire gain, especially in the midday. Spikes tends to get stuffed. Stuffed means likely to fail. If a spike is stuffed, it's likely to fail. Most of the time in midday, stock likes to get stuffed, panic likes to get holded. So in midday, it's really unpredictable. Sometimes it does the opposite, sometimes it doesn't. Only focus on in the morning or the afternoon. Midday perk pattern is the only strategies that I can find in the midday if you're a full-time trader. But if you're a part-time, focus on the morning strategies and the late day strategies. Either to hold overnight. If you're stuck in pattern day trader rule, you can use the strategies that focus on the overnight. CPAH is one of the patterns short into parabolics. Now, in this specific case, short into parabolics, and if you cannot find a resistance ahead of a really clean chart whatsoever, you cannot short into parabolics without any resistance until you can find a clear risk level. So first spike, spiked it to 4.77. It spiked it almost to $7. Hardcore pullback into hold this support, spike again into those $6 area. So 619, risk 680. I think that was a decent risk reward ratio to cover into the $3. But you don't know if this spike will hold. So if you're shorting into parabolic over 100%, be really, really careful. Always go small, always focus on your risk level. If it doesn't work, get out and you can always get back in again, especially without any resistance in the front. And always cover when the stock panic down to one half its own spike. So here will be my thought process. I see the stock will match parabolic over 150%, come back down, perks up again. I will take a small short around the $6 because first I'm shorting into parabolic, second I'm shorting into strength. So that's the two bearish factors I'm shorting into, but I'm not shorting into any major resistance. I'm shorting into intraday resistance, which is not that good, but I consider to be a resistance. So I'm shorting into 3 bearish factors. I can cover the rest of my profits at the end of the day. But in this case, if the stock consolidates and start perking up again, we'll be cutting my losses. So shorting into parabolics, they are all fast going up and they're also fast going down. And you don't want your stock to be consolidating. So when the stock is consolidating, means the stock is holding the same range over and over again, not breaking the resistance and not breaking down the support. It's holding the same level and didn't crack. That's something you do want to get out of a parabolic short, because when you're shorting to a parabolic, you don't want your stock to consolidate. Once you start consolidating and you notice that, get the hell out, because the stock can pull out some crazy squeeze or crazy panic into the next couple minutes. So when the stock is consolidating around the same range about 2 hours in intraday, that will be something not to be considered holding. So if the stock is fading, that's completely fine. In this case, stock is faded. Stock is slowly fading from 4.5 to 3.5. So it's not consolidating, and you can take your rest of profits at the end of the day. And here's another midday perk pattern from DCIX. You can see the flow is actually not 16.3k, it's actually around under 1 million. Market cap, I don't think it's accurate too, so I think it's under 10 million in that case. So the stock spiked from 4 to 5, consolidated, and didn't break down the open price. When the stock didn't had a morning spike, and not for that big, but it didn't and come down, start consolidating around the open price, that's something to be considered to be bullish. Once you start breaking out and start consolidating again, here will be a good examples for midday perk, because midday perk happens around 11 to 2 p.m. and it's a low float, no market cap, and the stock proves it has a spikeability in the history because of that shipping company hype. Diana Container Ship is a shipping company. So for traders' mentality, at first, you will have the first support around here, second support around here. So you have double support for you to risk off. And when the stock is perking up and spike again, think about a trader's mentality. So first, I will have one support, second support. It's like if your plan's failing, you always have a plan B, which is around the second support. That makes people feel safe. And it makes people want to go bigger. That's why midday perk pattern goes around in this case. You can see the stock spiked from $7 to almost $15. I think it spiked a little bit more, spiked almost to 20. You never know the stock is going to go to 20, so always sell into the strength. Don't be greedy. The stock is trading massive amount of volume through the entire day, so you don't need to worry about volume. As long as volume stay over 10 million, that would be really good for a midday perk pattern. The fourth pattern is called multi-day breakout, or week breakout, monthly breakout, or yearly breakout. So the longer the time is, the more convincing the breakout is. So year is over month, month is over week, week is over day, day is over hour. So the longer the time is, the more convincing the stock is actually breakout. And let's give an example about this multi-month or multi-day breakout. Let's look around the long-term chart. So if the stock has been traded around like that, and there's one day traded around really heavy volume and comes back down, start consolidating for about 1 month. And in this day, traded around, let's assume it's 30 million volume. Now here is $2, here's 1.5. Now, if today stock gap up to this, let's assume 1.8 area, because short sellers like to short, risking this $2 area by shorting into 1.8 and expecting stocks to drop. So let's assume open price start dropping into 1.5 and the dipper comes in and start breaking up. So here form some kind of cup and handle, and the stock break through this 32 million resistance. And the higher the resistance is, the bigger the success rate is, because short sellers like to judge the amount of resistance overhead of their position size. So the higher the volume underneath of a resistance, the bigger of the short sellers will size in bigger. So if it breaks out of that volume bar and the stock starting goes parabolic. Now let's show an intraday chart to give you a better understanding of this chart. So let's assume this is a 3-year chart. Now stocks pre-market gaps up to 1.8, come back down to 1.5, and start squeezing back up, breaking this $2 area. Now if the stock breaks this $2 and pulls back into this 2, and let's say pull back into this 2.05, and this one becomes the next support, because when the stock taking off to the new high, and that previous high will become a support. If the stock even consolidating on that level, that forms a clear support. That level will be my entry point, risking that $2 area. Once the stock starting breaking out, the higher the resistance is, the bigger it's going to break out. So short squeeze typically happens around 60%. So they can squeeze around 60%. Typically you can use this $2 times 0.6 plus 2 equal 3.2. So $3.2 will be your ideal selling point if there's no any other resistance overhead. But this kind of math doesn't work all the time. Only happens in really heavy short squeeze. So this one will be your ideal number. And always use your average maximum gain to take your profits and take profits into the strength. Now there's criteria you need. First, the higher the volume, the bigger the success rate is. So you need some kind of big resistance volume underneath the stock. And second, for this particular pattern, lower float, lower market cap. Of course, stock needs some kind of catalyst, and the ideal is stock breaks out first, come back down, and starting consolidating above the resistance. That is where your ideal entry will be. So if it's consolidating around this 2 or either 2.15 or 2.1, you're only risking 10 cents to have over $1 reward or either 50 cents reward. So you want to get your risk level really close to your entry point. That will give you a really tight risk, and you can also use that to increase your share count. After you are getting used to this pattern, you will do better and better. But when you are trying out this pattern at the first time, I would say starting small, looking for the criteria first, calculating your position size, calculating your maximum loss before going into a trade. A multi-day, multi-week, or multi-month or multi-year breakout, multi-month breakout or multi-week breakout happens the most of the time. Multi-year and multi-day happens less. So multi-week or multi-month, focus on that. And you also want to focus on really heavy volume traded too. So the stock is trading massive amount of volume. I would say after breaking out this 30 million resistance, trading around this 15 million or over 10 million to 20 million in the morning. So heavy volume trading in the morning. And that will be it for multi-month or multi-day breakout. And I will give a detailed explanation about this multi-month yearly breakout. What's up guys, Steven Dux here. Today I want to talk about MARA as a multi-month breakout. And this chart is it's one of the cleanest chart I've never seen for a while. This is something you need to focus for when you're going for a long side. You can see the stock went up 100% today, and they actually did have a double bottom in the morning, so that's considered to be bullish because it did not break this 320 area. Now next thing is, first you want to look for the stock has no market cap, no float, which meets both of the requirements, and it has some kind of news today. So now I don't really care about the news. I don't really care about what fundamental this penny stock have, because all penny stocks have really bad fundamental just in general. So if you look at the monthly chart of the 6 month, and you can see this is a really big multi-month breakout. So you can see 60 million volumes, 30 million volume resistance, 16 million volume resistance. So now when you see a stock is gapping up and it's already taking out the multi-month resistance, first you want to think, okay, so there's going to be a lot of backholders, which means people are holding this long term, are looking to get out when the market opens. So when the stock gaps up like that, there will be around 50 million resistance combined with July and October. And even November, 50 million resistance around this 230 area. So of the previous day, as you can, on a Wednesday, you can see it actually broke that to a 230 area and went parabolic and came back down. Now, on this current day, you're already soaked so much backholders because this kind of selling is backholders selling their shares or short sellers are shorting it. So after hour it went back up, so it's considered to be really bullish. Now, if the stock massive gap on the morning comes back down again, you can use that 260 as your ultimate support, and you can use this pre-market close to this $3 as your ultimate support again. So now you can buy into the weakness at the open. You can buy around 320 area, risking 3, or even you want to wait for the stock come back down a little bit more, so you do want to add around 290 or 280ish, risking this 270 area. So it's confirmed a multi-month breakout and it's huge spike in the pre-market. So it tells you the stock have its own strength to spike, and after it taking out that big of support and that big of resistance, you can use that as your leverage. And when you see there's previous day confirmation breaking out, that gives you even more. It just shows you the stock has the strength to keep going. And if it's the first green day gap up, there's no this slowly grinding up to this 270, and that will be a big morning. So if the stock opens up, backers comes in and starts selling the stock, and the selling pressure will be too heavy for the stock to hold its own spike. So when it's the first green day on the gap, the stock is likely to drop because there's too much backorders, as I mentioned a couple months ago. But if you have a day to soak all the backholders and you have another day dips back down to support, that is the perfect opportunities to take your advantage on the long side. So if you now to sell, if you bought around 320, even though 350 area, that would be still a good risk reward. To you're risking 20 cents for potential upside, and if you see the upside, there's actually no resistance ahead underneath with a heavy volume. So you can sell whenever the stock has strength. You can sell the strength around 413, but my general guess is around this 460 area because there is that's the pre-market high. So if you don't know where the top is, always sell on the current pre-market high, or you can sell on the strength to take a full advantage. That's almost $1 a share. That will be 20% of your return. So very solid, very solid pattern, and very solid entry. So if you can see it, you take advantage of it. Stock markets sometimes offer you the best charts and the most clean charts ever. So you don't overtrade. The opportunities always comes to you, and don't try to find opportunities. Forced opportunities will make you overtrade, make you emotional, and all that kinds of bad stuff. You want to stay rational. Know what you're doing. Know what your pattern you are trading. If it doesn't work, it didn't work. If it works, perfect. So always put the odds on your side. Don't go too big. Use the fixed positions if you are just starting trading. So that's my suggestions. Thank you very much. On DPW, this chart, especially dealing with this kind of grinding every single day, starting grinding up, and short sellers cannot push it down, or there's not enough selling powers, and the market cap is still pretty low. So, and also did an offering and grinding back, so it's very bullish. Lots of short stockiness overextending the gap down and start squeezing in the late day. This one will probably squeeze over 4.5 and have a massive squeeze. That's just my assuming, but it's hitting into this 4.5 area. But starting short around this 4.3, risking this 4.5. I wouldn't be trusting it because it doesn't have, I'm not trading with any patterns. So I'm trading with short into resistance. That's not enough factors for me to make a big short on this. So I wouldn't be rushed into short this DPW. I want to wait until make a clear move. I want to take a try to make it short, but it's unlikely to work. But if it dips down, goes red, I will have a really good starting positions. I'm willing to lose these small positions to the 4.5 level if it breaks, and let's see how the stock reacts. So first, when you are shorting into those stocks, and those stocks typically have really high reward, they're really overextended, you have to find at least 3 factors for you to short in. First, you want to short into big resistance. Second, you want to short into big resistance with volume, with average traded volume. I will say 20 million to 30 million, even the higher the volume, the higher the bigger resistance is. So on this part, it went to 4.5 on the December 4th, but it was trading the aftermarket. So there is not enough volume at this 4.5 level after aftermarket. So I'm not shorting into really big resistance volume because there's not enough average traded volume there. There's also a little bit of volume traded around this. It's only traded around this December 5th for, I would say, an hour. That's still not enough volume. So if you use those candle volume plus each other up, I don't think there will be over 10 million. So this one, 4.5 top, it's easy to break through. So the odds of shorting riskiness 4.5 will be not as good. Now let's see what stock happens. I think you can break that 4.5 very easily. 4.37. Stuff to around that 4.4 area. But if this 4.5 breaks, I think will be a big potential buy, because why? First, shorts are most likely shorting around this 4.3, 4.4 area, risking that 4.5. Once it breaks, they cover and they will create a short squeeze. You can take a full advantage of that first. And there's a second factor of the stock comes back even though it did an offering, so that's considered to be a bullish factor. Third, if you took a close around the bigger picture, there's a big resistance around this 3.5, which it broke out yesterday. And the reason why I didn't get in yesterday, because it pulled back into this 3.5 area again, so you don't know if it's gonna hold or not. But today it actually give you a solid dip around this 3.76. That will be, it shows you the stock can hold support. You want to buy into the breakout, so let the stock do what's it gonna do. If it fails, goes red, I will be adding into my that 4.3 shorts. Now if it break out that 4.5, 4.6 area, I will be looking to go long. So sometimes you have to let the stock play itself out and let the stock show you the direction. Don't try to predict the direction. This is sometimes let the stock to show its own range. This is a 50-50%. You cannot guess where it's gonna go. Let's wait and see what happens if it dips back down or if it breaks out. There's a common knowledge of if stock take down half of its own spike, the stock is starting losing momentum. So you hold this one half of its own spike, you start bouncing from there. This is the final chance for stock to break that 4.5. Let's see if it can hold. The bounce looks pretty strong right now. VTGN, as I said, see, took profits. There's typically 3 pullbacks. 1 pullback push, 2nd pullback push, 3rd pullback push. That's it. And you start coming back down or start consolidating. So that is the time frame for part-time to take a full advantage of. It only takes for you get up around 9 o'clock and you finish around 9:40. That's only 40 minutes of trading. But typically I will take most of my position or my full positions after the 3rd push, because I don't like to risk that 3rd one because not enough good odds there. Now let's see if DPW can push over this 4.5. It looks really bullish right now. For this kind of stocks, when it's trading this much volume, it traded, I would say, 200 million volume for the last couple of days, 40 million one day, 10, 10, 10. So that's 70 million, 100 million, 140 million, 150 million. So when it's trading not much volume every single day, you cannot total. You don't need to be rushed. Wait and see, because the higher the volume is being trading, the more mistakes people are making in the stocks. So if you make a correct direction, if you make a correct decisions, you will still make a lot of money, because a lot of people already made the mistakes in the stocks. They create a bunch of gaps in this kind of stocks. So wait and see what's going to happen. Now stock is showing significantly pullbacks. Dropped 50 cents from there, dropped 10% from its own high. I think it's pretty much done. I still won't be rushing into this DPW. I still have my partial positions around 4.3, 4.4, basically not 4.5. Never try to rush into a heavy volume traded stocks for the last couple of days. And the stock is green, so don't rush into that. Wait. You need patience. Because shorts likes to chase here. They like to chase into weakness, but if the stock bounce back, they will get nervous and start covering again. So never get into those kind of circle traps. Don't short into weakness. Wait and see, especially on those not very good odds of stocks. Like you're shorting into not very heavy resistance. The stock looks really bullish right now. Stock bounced back from that $4 area. Very, very good strength. Now, overextended gap down, sometimes it doesn't have a morning push. So this is what you can do without missing a short chance. So first, I break down my entry point into 3 parts. First will be, if I see a gap down, it's not under, I would say it's not under 20%. So it's not negative 20%. It's like negative 10, negative 8%. I will be taking 1/3 of my position over in the pre-market, because first, overextended gap down works really well, has really good winning percentage, but most of the time there's no push. So you can't get into a trade without any entry point. So typically I get 1/3 of it in there. If it drops, I make some money. Now if it push up, I can get my add into risking the closing price. My profits will be a little bit worse. But most of the time, I would say most of the time overextended gap down works, but 1/2 of the time overextended gap down doesn't have a morning push. So using that 1/3 of your own positions gives you really good odds. If the stock doesn't have push, you can still take in profits. But if it did, you can still add it into it. So you try to maximize your profits into this kind of pattern. That's just my typical way to play overextended gap down. That's for say you are. Now DPW start runs back up and it took out that 4.40. You hold that $4 area. I think it's gonna take a breakdown. If I'm shorting around with my starting positions around 4.40, I will be getting out of DPW right now, because it looks really bullish. It looks like it's about to break that 4.5. I'm going to get ready to short, and I'm going to get ready to go long after breaking 4.5. Now the next support is probably around this 3.99 area, will be around 4. So if the stock comes back down and re-break that $4 area, that's probably where I'm gonna go short at, because stock is overextended, but it's green and we caught a lot of shorts in there. This $4 to this $4.5 range, I won't be touching it. And until the stock makes a clear move, then I will be pulling my triggers. And the stock will give you a clear direction which way it's gonna go. I think it's gonna break that 4.5. Let's wait and see. 4.34, 4.36. Okay, looks like shorts is covering. Big bids, 4.45. 4.50. Yep, took it out. So here it will be my buy signal for DPW. I will be getting around, I would say, 1/3 of my positions. So I want to see the stock consolidate so it can actually hold 4.5 for at least amount of time. Then I'll be adding into dips after breaking out of that area. The third pattern called gap fill close. This pattern doesn't really happen that often, but if you're trading part-time, you can always 2 points you need to notice. First is stock is gapping up hugely in the morning. One thing you need to notice. Second, the stock filled its own gap at the market close. This is only two things you need to pay attention now. So let me explain why this gap fill strategy works. Why is a long strategy from the psychology part. First, let's expanding from intraday view. First, you see a stock massively gap up. Let's assume it's massive gap up, typically considered to be 100% or above. So if gaps up over 100%, now if the stock, this is the long-term chart, if the stock is for 1 year is doing nothing, and didn't even trade that much volume, so didn't really trade big volume over, like didn't even trade over 10 million volume for the past 2 years, and just trading sideways. So for long-term investors, when you are day trading, you have to always think about long-term investors. If they're a long-term investor, and most people cannot trade in the pre-market, so keep that in mind. If your long-term investors see their stocks are massively gapping up, what happens? What they will do right after the market open, they will sell to take their profits. So why not just take 100% of their profits? So once they start taking their profits and chasers trying to buy the stock and get shorted from short sellers, there's short sellers, there's long-term investors trying to sell too. That will cause a massive panic. Typically, when the chasers start chasing, there will be a little bit push right after the market open and start panicking because long-term investors trying to sell. And here's the open price. Because typically stock is green for all day, so you don't need to worry about green to red, red to green. And the stock is holding 1/2 of its own spike and start consolidating in the midday or try to perks up, and it didn't fail at end of the day. So here's 4 p.m. and if the stock closed around the open price or closed higher than the pre-market high, which is around here, the stock is very, very bullish because number one, because it closed very strong. That's a bullish factor. Second, because in 1 day, think about there's a lot of long-term investors, and in this one intraday, and all the deep buyers can overcome all the long-term investors and make the price go to where the market where they opened. So that shows there's an overwhelming amount of buying power in this intraday, in the current day. So that will typically on the second day, as long as at 4 o'clock the stock finished really strong, most of the time stocks start gapping up, making this double top or starting forming some kind of copy handle and start breaking down in the second day. Now I like to sell, this is an overnight hold most of the time, and to sell into the second morning spike. Same thing, how to take your profits. Look at the history of the stock, if they have any resistance. If not, use your maximum average gain to take your profits. If you see momentum weakness, taking out that 1/2 of its own spike, get off the stock and take your profits and run. So this is how, gap fill close around open price or above the open price. Now for this specific pattern, the stock doesn't need to be low float and no market cap. Why? I use statistics to track my own data, so this one typically doesn't really matter. And the way to size in, you have to size in at the market close. So I would say 3:59 p.m. to 4 p.m. and sell into the second green day morning spike. So gap fill has this day has to be the first green day. So second green day morning spike. This is a simpler version of gap fill, and as long as you stay your risk under control, because typically in the midday the stock likes to start grinding up and have some kind of consolidation level before it goes up. So you can use that kind of find the consolidation level, use that as your risk to buy at the market close. Now, if tomorrow gaps down, you can still using that as your risk. So always be safe. Always worry about where your risk will be, what's the worst situations will be happening, and think about what's your maximum loss. So when you size in, no matter what patterns are you trying to size in, always have a maximum loss. Calculate your maximum loss and calculate it by your share count and go into a trade. Go into a trade with a plan and you will be good to go. TRXC is the perfect examples for gap fill strategy. As you can see, the pre-market gapped from 1.5 to 3.5. That's over 100%. So once it starts coming down and the long-term shareholders start selling into the panics and people who are chasing at the front got sold down, and when the stock started slow trending back up into the closing price and finished relatively really strong and didn't have some kind of massive panic into the close. So typically the best odds you can see of gap fill, you can see there's after hour spike that breaks the open price or that breaks the day high, and that typically increase your winning percentage of gap fill. And as you can see in the next day, a morning spike expect all the way to $5. So if your entry was 2.75 around $3, and you can make almost 60-70% of your return. So this kind of patterns doesn't really happen that often, and the flow doesn't really matter. As you can see, the market cap is 404 million, the flow is 127 million, shares is 148 million. So you don't need to focus on the low flow, and as long as the volume is good enough, the highest candle of the day is 2.5 million. Whenever you can see the highest candle of the day is 1 million or even 800,000, that's considered something a stock has decent volume of the day. As you can see into the next day, the highest volume candle is 2.5 million. That's traded higher the volume in the previous day, which means has even higher odds of the stock going up. If the stock has higher volume than the previous day, the stock is likely to spike rather than drop, because the more shares going to be traded, most shares are hold, people are going long. If you are going short, you are always the small percentage of the stock. So in typical stats, there's only 10% people are shorting into the stock. So the more shares being traded, the more percentage was going to belongs to long. So once the long start filling the flow, the short is going to get squeezed. And the more volume is being traded, the dangers will become for the short. But once the downside comes down, the more volume is being traded, the more resistance there will be. So that will be benefit for the short side, increase the winning percentage and increase the odds also. So on the upside, the higher volume be traded, finish strong, and the deep buying power overwhelms the morning panic, and that is called a gap fill. Because 1.5 to 3.5, there's no actual volume traded, but once that gap get filled by the actual market hours or by the actual dip buyers that traded a decent amount of volume, the gap has been filled. Once the gap has been filled, it's a really bullish sign. The stock has tended to go higher than the previous day. There's another gap fill strategies. As you can see, the stock went from 1.25 to 2.5. Expects 87% in the pre-market. And same thing, a long-term backholder starts selling into the morning panic. And as you can see, the stock holds half of its own spike. So when the stock is holding double bottom, panic down to half its own spike, dip buying there, dip buying the double bottom. When the stock is holding one half of its own spike, it's a bullish factor. So when the stock is slowly grinding up, has a midday panic, and higher low stocks start trending up and start threatening into the day high. Now, typically for gap fill, your entry is supposed to be at end of the day or in after hour. But in this case, you have to wait until end of the day, because at the end of the day, the actions will be really volatile. The stock can go up and down really fast. Sometimes it can be an entire shift for stock momentum to change. So that's where you want to be careful. always entry around the after hours or right before the market close, which is around 3:55 to 4 p.m. Really simple, holding double bottom, higher lows, start threading into the day high and strong close. Now in this case, I don't think ONSCS closed very strong. I think it dipped down to 211. So if the stock closed really weak, that's a really bearish factor. So that doesn't match the gap fill. The gap fill has to meet the criteria that close really strong. So if you miss one criteria, you lose a lot of odds to win a specific trade. Same thing, the market cap is typically higher than 50 million, flow is higher than 10 million, and you don't really need to care about the market cap and the flow. Focus on the volume. The highest candle is 1.2 million. So that's a decent volume being traded. That is for ONCS. The fifth pattern, I want to talk about parabolic short. So this one is really tricky. I wouldn't suggest for beginners to try it out this pattern because sometimes it can be really risky. Low flow stocks can go from 2 to 20 without any pullbacks, even though a pullback can still go in. So I always suggest shorting into long-term resistance with the parabolic shorting. Assume the stock consolidates in here, goes back down one day on this day and traded around, say 20 million shares, around $5 area. Now, this is the 6-month chart. This is the intraday chart. And if the stock goes parabolic, to zoom from here, here's around, let's say $2, all went to $5. And for most parabolic short, you don't want to short right at the exact point around this $5 into the resistance. You do want to short around this 4.5, 4.7, 4.3. So you want to break down your position size into parts because sometimes the stock doesn't go that far and you miss your opportunities. So I typically use a large range of different price point to add into my final positions. So first, I'll be shorting around 4.3, adding into 4.5, adding into 4.7, and adding into 4.9, and my average will be around, I would say 4.6, final average risking $5. That is around 9%. And the downside, I would say typically breaks down into half, so 2 to 5. The range will be is $3 and drops around $3, cutting in half, it's 1.5. Land around this, probably end of the day fades to 3.5 area. And for the parabolic short, the stock is going straight up, something looks like this kind of shape, and volume trading higher and higher and higher, and then it's all green candle, green candle, green candle without any pullback. We call that our parabolic short. So typically when parabolic short fails from a resistance, it typically drops half of its own spike. So use the top price minus where they started and divide by 2. And that's where use the lower price plus the 5 minus 2, divide by 2 is 3.5. Now, the next thing you want to look at is the lower the flow, more dangerous parabolic will be. So the higher the flow, it's actually better for shorting positions. The higher the flow will increase your winning percentage. So winning percentage go up, winning percentage go down. Second, the bigger the market cap, the better it is. It doesn't have to be, if it's a really low market cap, if it goes parabolic, it's typically stretch out a little bit longer than you think, but the bigger the market cap, increase your winning percentage, goes up. And when the chart is doing something like this, now if it doesn't have some kind of 20 million resistance at this $5 area, the stock can just keep and pull backs down and can just keep going. And it can go to $20, $30. You will blow up your account. So shorting into parabolics, it's very dangerous. You have to short underneath the resistance for the safest entry. If it doesn't have one, then disregard it. You don't want to touch into that. If the resistance, let's assume it's around 4 million. And I have mentioned that before, if the resistance is not over 10 million, it still will be dangerous. So there's one signal that will tell you that the stock is going dangerous. So typically for parabolic short, people like to short before hitting $5 will be 4.5, 4.7, 4.8. But if it just straight goes up and start busted to this $5 and starting to have a pullback, that's something that's not very good because short sellers are already in trade around this 4.5, 4.7 and didn't even affect the stocks going to the $5. So it's straight from this double top. When the stock pulls back down, the short sellers are stuck around this 4.5, 4.7. They will likely to reduce their share amount. That will cause to buy back the stock. The stock will increase again and will form a big cup and handle and destroy the short sellers. So most of the time when the stock is going parabolic and suddenly form a double top without pulling back underneath this $5 area, so around this short seller's position, 4.5, 4.7, it didn't pull back, it just straight busted out to the $5, then pull back. That's very, very dangerous for the short sellers. So I typically just get out if they're starting forming this double top and without any pullback into 4.7, 4.5. That's one of the signals shows the stock is going to break out further. So that's something to keep in mind. The next thing is when the stock is trading parabolic before, so you have to notice the stock behaviors also, what the stock like to do after the parabolic. Most of the junky stocks, if they go parabolic and this is the 4 o'clock, they like to, most day traders like to trade those low cap, low float parabolics, and they like to sell right into market close because they don't want to see after our offering and make the stock drops to 50%. So the stock likely to pull back to death drop right before the market close. Now, if the second day, now let's assume this one traded around 4 million shares today, and into the next day, you start going parabolic again. So this is $5. And when it reaches to this $5, you already traded 4 million shares in that morning, not the entire day. That means the stock is going to end up more than 4 million shares traded on the day. So when the stock is trading more shares than the previous history, you have to trade it like a fresh start. So don't use this $5 as your resistance because it's unlikely to work. When the stock is trading massive amount of volume than previous history, trade like a fresh start. You can use the stock behavior to use that to keep in mind to make an entry later in the day, but you don't want to use that as your resistance to short into because it actually form a double top and start go up again. So that's something for parabolic to keep in mind. Those are the 3 criteria to increase your winning percentage. And shorting into parabolics in the afternoon is the safest because day traders like to take their profits before the market close. Why? Because they're afraid of after our offering. So shorting into parabolics in the afternoon has higher winning percentage than shorting parabolic in the morning. And shorting into resistance of parabolic will give you even greater winning percentage than shorting without any resistance just by feeding on your gut. When you are shorting into strength, yes, you are shorting into strength. You are shorting something blindness without any, because it's a parabolic, you don't know where's the top. So that's why it makes it so dangerous. As long as you are very experienced traders, then you know what you're doing. You have a great account size, then go for it. But for average account size people, I don't suggest to short into parabolics without using any heavy resistance before in the history. And that is for parabolic shorting. Today I want to talk about parabolic shorting, and this PZRX, it's one of the patterns I use the most. So in penny stock land or small cap land, almost every week there's going to have like 2 to 3 parabolic shorting, and to find a correct resistance you have to be looking at the long-term chart correctly. So most of the time you want to pick the previous resistance as your risk, but when the individual volume are not strong enough, if it's not over 20 million, it doesn't consider as a really strong resistance. So what I normally pick is the most consolidating area and where they land the most, which is around this 193 to 195, this area. So if I'm shorting this PZRX, that will be my ultimate risk. So I always want to short into strength. I will be shorting around 160, adding 180, risking 192. So the average will be around risking 20 cents ish. That will be my thoughts of playing this parabolic short. And most of the time you don't have that really close range of shorting, so you have to be really careful because you don't want to go in with your size too big if the range is really big. So if the most consolidating area is 2.5 and you're trying to short around this 150, so like that gives you $1 of range of adding. So your starting positions has to be really, really small. But the range are really tight. You can sometimes get away with it. You can start in pretty big, or as one, I think today is back to 160. So you can go in with half your shares 160, half your shares at 180, and you should be good to go. But this is how I typically trade all those stocks. But if you can find some kind of heavy resistance, like over 20 million volume underneath, and if the stock spikes to this $3, that will be a perfect short of this parabolic / bounce short. If you can add two short patterns together, it will significantly increase your winning percentage of shorting. That's a really, really useful pattern. In here, I want to explain why shorting into parabolics without any resistance is very, very dangerous, especially when the flow is under 2 million. You can see that the stock flow is around under 1,757,000. Market cap is 28 million, so it's a micro cap under ultra micro cap, which is under 50 million. So to see the long-term chart, and there's no any other heavy resistance or even light resistance overhead, it's just massive downtrend in the history. This is something that trader I really not be careful, because this kind of chart will create some kind of massive short squeeze in the history, something like DRYS. As you can know that the shipping sectors in last year November, it went from 4 to 120. So people know those kind of shipping sectors have the potential, has the specability. So there's only resistance around this 14 area, that is around 3 million volume. So when you're shorting to 3 million volume, that is when any resistance under 4 million volume, that doesn't consider to be a resistance. When trader doesn't know this specific methodology, they're shorting into this 14, and check out the stock went super parabolic from 4 to 20, and if you're shorting at 14, you're down 20%. So on this specific shorting to parabolics, don't short into any parabolics without heavy resistance, especially on super low flow. And you will get something like this. You keep squeezed and squeezed, get emotional squeezed to almost 20, and you're so afraid of the stock's gonna go higher against you, you will cover, and that will give you a big loss. So as a short sellers, shorting into afternoon into parabolics, that's a little bit more odds in your favor, because those kind of fundamental trash stocks, they like to offer some kind of offering, or like you have some kind of bad news overnight or over the weekend. So that's why day trader doesn't like to hold overnight. That's why the stock tends to drop before it closes. Now you have to wait until it hits the afternoon, which is around 2-3 p.m. Then you can maybe short some little bit and have a really decent risk reward ratio, and you have a specific risk to risk on, because if you are shorting into parabolics into strength without any resistance, shorting into 12, shorting into 13, and goes to 20. There's no plans, there's no risk reward ratio, there's no risk level. You're just shorting because it looks like it's about to go down. That doesn't give you that kind of methodology just doesn't work, because there's going to be that one or second time will destroy your entire account because the stock just keeps going. So that's something you need to keep in mind, and that's the potential danger for shorting into parabolics without any resistance to risk off, and shorting into strength without any other factors in your favor doesn't work that well. The sixth pattern is called the bounce short. This short is based on parabolic short, but there's different criteria for bounce short to be able to work. First, stock has to be running before, so stock has to be around, I would say 6 months to 1 year before, within that range, so you can use that resistance as your reference. And second, you need to check is the individual volume underneath the different spikes. So if the stock is spiked once, spiked twice, spiked third time, fourth time, and fifth time, and check out the individual under each spikes. And if the volume is at around the same level, let's assume $5 is right here is 20 million volume. Right here is 11 million volume. If the price are around the same, you can use that two individual volume plus together, so it will be 31 million volume at the $5 range. If they're not in exactly the same price, don't use them to add together because that doesn't really work. So the stock has to be ran before, check the individual volume. And then the third is typically when the stock is starting around again, now it's in real time and starting around again, you can use typically most of the time here, you want to see where the price has been back and forth the most. So here is the most consolidating price. Even though it's not trading that much volume, but people like to use the straight line of lining up the most consolidation area, which is around right here. So here will be your sizing point, because when the stock is running again, there's multiple resistance. Which one you're gonna choose? So I typically choose the highest and the most consolidation area. So 1/4 for the most consolidation. Typically in the middle, I use another 1/4, and at the top I use 1/2. I will say before it reaches to this $5 area, so it will be 4.8 or 4.5. Right here will be around $4. Here will be 4.2. So when you try to size in, always break your position into parts, especially on parabolic bounce short, because bounce short is something that stock has went significantly higher. It doesn't really have to go parabolic before, but you went some kind of supernova. Something went from 1,000%, went from 1 to 7 or 1 to 10 or 1 to 5, so something ridiculous. And then stock comes back down again because all supernova dies of all penny stocks. Then start consolidating on one day or starting gapping up in the pre-market. That's considered to be a bounce short. Bounce short can be occurring in the pre-market, can be occurring anytime during the day. And you can start in your short here, and once the market open, you can add into the push. That's called a bounce short. And if it happens in the middle of the day and start going parabolic again, you can use the bounce short as well. So typically bounce short, you want to short into heavy resistance to increase your winning percentage. Most of the time, you want to short over 20 million above resistance. That gives you the highest winning percentage. The lower it goes, the lower the winning percentage goes. So that's something to keep in mind. And to take profits of bounce short, because this is where it's a little bit different than the parabolic short, because parabolic short, most of the time, they go parabolic. Of the first time, they come back down, and they land around this 1/2 area. But for bounce short, they have different behavior, because when after it goes parabolic, it comes back down, they sometimes go down almost to where they come from. So when you're doing bounce short in the morning or in the midday or in the afternoon, if you took your positions and the stock goes into your favor, this is what I would do. Take profits around this 1/2 area and leave the rest of it until end of the day. Don't ever hold any penny stocks overnight, especially you're really confident and really experienced. So 1/2 end of the day. And for morning bounce short has to be, the criteria has a little bit lower. So for example, if you are trading in the morning and stock gaps up again, hitting that resistance called bounce short, and the stock doesn't have to be over 70%, it can be 30% is too low, 40% is a little bit okay, so we'll say 45% or above. You can use that as a reference to bounce short. The higher the percentage that it gaps up to the resistance, the higher the winning percentage it is. So if it gaps up 70%, hitting that 50 million volume resistance, or gap up 100% hitting a 70 million resistance, this one has higher winning percentage than the 70% that have 50 million resistance. So to pick a stock to use this pattern, pick one specific stocks that have the highest, that meets all criteria and has the highest winning percentage. Why do I size 1/4 in here? Because most of the time when stock trading this heavy volume back and forth, in the most consolidation level, they still have some kind of volume traded. It's really small, but it's noticeable. You can add all those levels together to calculating the resistance of that consolidation area. typically give you around 10 million. I will give more examples to show how bounce short works, but this is the general idea of bounce short, and let's get down to the examples. Today I want to talk about the ticker called DPW, and almost every single time when the stock has been trading heavy volume for the last couple days, actually this is traded almost a week and a half, and when every single day is traded around 10 million, 20 million, even 40 million, sometimes 70 million, and stock like to announce some finance news to raise the money for the company. But for the chart by itself, it has 70 million resistance around this 4.37 area, and that day retested around 408. It failed again, and the most consolidation area will be around this 3.5. That will be a new entry for this DPW of shorting, because the stock has trapped so many people who are going long, and almost this kind of volume and this kind of resistance of downtrending pretty much unbreakable. So shorting into this 3.5, 3.4 will give you a really good risk reward of shorting around this 3.48 will be a good risk reward short into the Friday fading, because when the people are buying or selling around this 3.3 area and the stock instantly dropped to $2 and it bounced back, people like to cut their position size into even, so they like to sell where they bought from. So that's why the stock failed from this 3.4. So most of the time, if you see a massive panic from the stock and stock comes back up and retest it again and it failed and start downtrending, if we can break this where they started and just keep going to the 3.7, 3.8, that will be considered a really bullish factor. But when it's testing that people wants to cut even their mentality and their psychology and didn't break that resistance, that considered to be really bearish, and stock will likely to trend down for the rest of the day. And stock announced some kind of news that anything involved with offering shares into the market, selling, converting shares, and raise money for their own company and for their own benefits, that's really bad for investors. That's why the stock is likely to trend down for the next week and probably ends around the low 2 or the high 1s. I want to talk about how to deal with failed fake out. Sometimes when you are trying to use the patterns to short. So for example, MYZ, as you can see, the most resistance are around this 1.14 to this 1.12 area. But yesterday, expected to 1.28. So it is actual breakout yesterday, but once it took out that 120 and instant dip back down to this 120 resistance again. Sometimes we are not sure if it's a breakout or it's a fake out. You have to wait until the stock consolidates. For example, if you go to this 2-day, 2-minute, the stock took out that 120 area. It's kind of struggling around this 120, 130. It is consolidating, holding its own support, but the consolidation was not long enough and instantly dipped down to this 120 resistance level. So for most of the time, when you are buying the breakout, when the stock instant dips right back down the previous resistance, that's definitely a sell, because when you're trying to hold the stock took out and it's a confirmed fake out, it typically drops another like 20-30%, because most buyers are trying to get out. So when the stock break out of the resistance, break for like a couple cents and instantly drop underneath the resistance, that is a bearish sign. So don't try to hold and hope, because all those patterns are really deadly. So when you're trying to use a bounce short, this is actually a pre-market gap plus a bounce short as well. So two patterns are combined together. So they have really good shorting winning percentage. So also you can tell the stock doesn't really hold its own spike. It spiked one day, fell, spiked one day, fell. So it fails its own spike many times recently. And you can't expect the stock can break every single resistance in one day. So most likely the stock doesn't hold its own spike, but if you're shorting, risking that 120, And same thing, you don't want to hold and hope, because what happens, the stock has that 10% chance that took out this entire resistance and goes to $5. And if you're holding, you will lose all your money. So I would say if the stock goes to 130, I will cut my losses. If you're shorting around this 115 area, risking is 120. If it goes to 125, I will still be cutting my losses because of my discipline. And if the stock goes over and didn't hold that long, and it's a confirmed fake out and go back to the under the resistance again, I will be re-entry as my short again. So there's no need to worry about making mistakes on the chart. Always respect your rules and stay disciplined. That will bring you consistently profit, not hold and hope. For PXS, this is a very good bounce short pattern, and to judge what kind of stock behaves gives you a great understanding of when to short and when to go long. So first you want to look at around 4-year chart or 10-year chart to see if there's any big resistance ahead. And according to this chart, the stock was doing nothing for the past years except for this couple days. Now, so you want to focus on those couple days. First, I want to give some tips to people who are understanding how bounce short works. And when you see this kind of charts, focus on the volume. So first pop was on this November 27th, went from $1.6 to $5, only traded around 2 million volume. So that's very, very light volume. So if the stock starts spiking again, when the stock is trading large volume in the morning, you can kind of guess how much volume will be trading close at end of the day. Now take a look around this 15 days chart. So at this day, traded around 2 million volume. And so if I want to choose a bounce short pattern, I want to short into this resistance, that is unlikely to work. So first, volume is at 2 million. That's not very big resistance. It's very light resistance. And what happens if a breakout would cause a big short squeeze? Typically, I won't be using bounce short to short PXX if the volume is under 10 million, especially on those parabolic stocks. Now, if it's under 10 million, now if I would like to take a chance to use the bounce short pattern, I will be shorting around 509. But when the stock just keeps spiking past this 520, when the stock reaches 520, it's likely to starting breakout. Because most short sellers like to choose a risk level, so they like to short around 4.8, 4.9, risking is 5.24. When the stock broke that short seller range and started forming a double top, short sellers are nervous because I've so many short sellers shorted around this 4.8, 4.9 area. Why didn't it drop and keep going up and showing strength and forming a double top? So at this point, it's really likely to form some kind of cup and handle and straight broke out of the gate. In this case, you spiked it to this 502 and pushed to 524. So when it started forming a double top, I already know the stock is going to break out because stock didn't pull back and started squeezing again, formed this likely cup and handle and broke out this 538 and went super parabolic from there. So most of the time, don't use bounce short strategies if the volume is under 10 million, because that's not a very, very good resistance for you to risk off, and it's really likely to break, especially on those really low market cap and low flow stocks. Given the stock behavior, the stock likes to drop in the afternoon and just completely dies from where they came from. So this stock probably will do the same thing. And if you short around this afternoon after this parabolic is over, that will be a really, really good risk reward, because at same thing, if you're using this 5.32 as your support, that is unlikely to work because the volume is really low for both support and resistance side. So never use something parabolic traded really less volume. I can't tell you it doesn't work all the time, but most likely if the stock reaches high volume, it's unlikely to work. Also, when the stock is trading around this area, because when you're trading in real time, you don't know the stock is going to trade this much volume the rest of the day, but you can basically judge how many shares already traded when it reaches to this resistance. And if the stock is already had 2 million volume over, you don't want to short into that, because at this November 27th, you traded 2 million volume an entire day. And when I'm trading in real time at this, I would say 11 o'clock, it already traded 3 million shares. So I can kind of judge at end of the day probably will trade around 10 million shares. And that's a lot higher volume than the previous couple of days. So when the stock is trading higher volume than the previous one, you have to trade like a fresh chart. So that's why the resistance and support for the previous light volume is unlikely to work. Now for this day, December 4th, the stock has the same behavior, just likely to dump at late day. Dump late day, dump late day. You can basically use these 2 days to judge what will happen for this PXX stocks drop in the late day. You can also use the bounce short patterns, but in this case, people like to short around this $9 area, risking is $9.30, but the stock went super parabolic and the buyer just went insane and broke this area. So I will cut my losses if I'm using this as a bounce short, because as a short sellers, the range is very, very big. Now let me explain what does range means. So this one went from 2 to 5. So basically you're shorting 100% parabolic, but the volume is very light. So I wouldn't be shorting that. But on this day, I've been using December 1st volume as my references to make a judgment on the stocks. So stock went from 2 to almost 10, went down to the 3s, and start spiking from 5 to the 10s. So that's why I'm shorting 100% parabolic, but the volume is a lot higher than the previous one. So the volume traded on this day, I think it was 14 million. I'm shorting into a 14 million resistance. That has higher odds than use a bounce short and the previous one. So I will be shorting around this 890-ish, risking this 930. But the stock didn't even pull back and just went broke straight up the gate. So I will be cutting losses of this 950, and stock keeps getting halted and halted and halted. So people doesn't respect their risk level. I really like to add and add and add. I have no problem with that. I just think there's too much risk if the stock goes parabolic like this. Especially stock when the bounce short pattern failed. So if your short sellers are shorting this high 8 area or close to this 9 area, the stock busted to 12, that's too much pressure to hold. Like that gives you so much body stress, and it doesn't make you think right. It doesn't give you calm thoughts. The better thing is to wait until the stock shows that kind of resistance and use the intraday chart to make better decisions. So first, the stock broke out this 930 area, went all the way to 12. Now, I wouldn't be holding until 12. So I'll be cutting losses around 10. So I lose 10% of my position size. But if the stock comes down, now here's the point. So today, now on this December 4th, if the stock goes up from 4 to 12 or 5 to 12, here will be a very, very good psychology to take advantage of, because when people see this panics, they like to sell. And you have to understand, most short sellers are stuck in this high $8 or $9 area. So they like to cover even, or they like to break their gains and loss in very, very even. So it doesn't matter to take a small loss. So that's why the stock bounced from this 9.57 area, because most shorts are stuck around this 9 or 980 or $9 or $8.90. The stock bounced again. Now here, you don't really know the stock's going to keep going or not, and you cannot guess. Let the stock does the reaction first. So the stock is bouncing back and forth around this 12 area, and you finally start panicking. So as a short sellers, never hold when a bounce short start failing and stocks just keeps going. You can't risk that. Always respect your risk level. So the stock packed down to this $8, 8.7-ish, and you know the stock behavior is likes to dump at end of the day. Now, when you're trading in real time, you can clearly see this highest volume bar is higher than December 01. So today, on this day, we'll trade a lot higher volume than the December 01. So that will give a bigger resistance than previous days. And if you're shorting into this pop, risking this most consolidation area, 1040 or 1012 and start panicking and likes to dump at the end of the day, that's very, very predictive because that's how the stock behaved for the last couple of spikes. You can take a full 50% gains because just by noticing the stock behavior for the last couple of days. Now today, December 5th, now week open, stock likes to week open and start getting halted because going higher, going really, stock likes to get halted and start parabolicing from there. But today's chart, I wouldn't be shorting here though. I will be shorting partial at the most, shorting partial around this $8 area, but I do want to use this most consolidation area, which is around this area, $9.50 or $9 as my risk, but I didn't hit there. So the risk range is a little bit too high for me, but I can reduce my position size to get some kind of nice profit margin from there. But here is not a really big short because the stock didn't behave like this before. So the maximum I will do is like a partial size, but for this December 4th, that will be a really good shorting opportunities as a bounce short / noticing the pattern behavior than bounce short, because bounce short didn't really work December 1 because 1 and 2 light didn't work on December 4th. Sometimes when pattern doesn't work, you have to cut your losses because in this case, when the stock taking out of that $9 area, you don't know where it's gonna go. You can go to 20, you can go to 30, you can go to 50. You can't risk that kind of loss. So by trading the stock market, you have to be afford to your losses. Think the worst will happen, then manage your risk, setting up your position size, look at the bigger pictures, using the correct risk management, and that will give you a really good profits. Sometimes you need observations other than the patterns because patterns come from observations, not people tell you what to do. After 30 minutes later, the VTGN did crack below 2. That's exactly what happened, exactly what I said. 2 intraday top, very deadly, and always take profits along the way. The profits I recommend is taking the profits into the support level before the morning dip, which is over, it has to be over 1.85, so 1.93. I said I would take all my profits around 2. I took it, and that is the pattern of VTGN. This one might crack further late in the day, but you have to take the mean of the move. And that parabolic of morning spike into resistance, perfect overextended gap down pattern theory. So make sure understand and take advantage of it. DPW did exactly what I said yesterday. Huge panic, bounced to $4 and start dropping down again. This one might fade into the ones, the low 2s or the high 1s when this one finally settle down. And stock is, I would say it's not predictable, but you can definitely tell what is hard for a stock. So once you track multiple plays or hundreds of plays, you can kind of tell what is the winning percentage, what is the average volume, what is average resistance, what considered to be a heavy resistance, and you can based on that to react on a stock and basically make a plan and react on where you think the stock will be, and you start from there. Stick on your plan and you will always end up good. So next pattern I'm going to talk about is called first red day. This one typically happens in the morning around 9:30 to 11:30 a.m. And there's a couple criteria you need for this patterns to work. So first, the stock has to be overextended for days. How to judge a stock is overextended? So to look around, I would say 1 month chart, and the stock is basically going supernova. So candle, green candle, the candle goes bigger, then bigger, then bigger, then bigger. So for first red day, you don't have to be in rush because when the stock is already overextended, if you rush into it, the stock can have a further short squeeze. But wait until the stock shows weakness first. That's you wait for an entire day to see if the stock it's running on low strength. So this is the multi-day chart looks like. Now let's show you an intraday chart. This is 9:30. If the stock is losing strength and start morning push, bounce back, bounce, and starting fading and close weak at end of the day, either the stock is green or red. It doesn't really matter, because if the stock is overextended, as long as has a failed morning spike and have closing week. To judge first red day, you need those two factors to be in the chart to be able to confirm it's a first red day. Now it doesn't really matter the percentage is green or red, but as long as it has failed morning spike, never come back up in the entire day and close the week. So you have to assume red candle here. And typically for almost every single overextended stocks, as long as they're really overextended, like went from 1 to 100, then you can drop 80% to 90%. Now, if it's a typical, not really crazy overextended, went from like 1 to 10, maybe 1 to 14, 1 to 20 maybe, it typically cuts half. So once it starts cuts half, will land around this point. So the key advantage is to take shorting after this first red day is to get this profit. Now typically it's around 20% downside or 30% downside or even 50. So this is why you are trying to short first red day. You are trying to get that red candle, and if it hits that one half of its own spike. For intraday entry, once you see this first red day, closing week, failed morning spike, never comes back down, don't focus on the percentage. If it's red, it's even better. But if it's green, I think it's okay. So on the intraday chart, let's see, this is the previous day, first red day. And in the pre-market, it goes down. Now you have to leave your position size for further add positions, because when you are shorting into weakness, always leave partial position for you to add, because most of the time stock likes to show some kind of strength. I like to short right here, the day on the first red is around 1/4 of my positions. Now if tomorrow start going weak and if it start moving up to this some kind of major resistance level, I will have room to add. So I will add in the mid for another 1/4, add another 1/2 when I hit into that major resistance area. So right here is 1/4. If it has strength, adding another 1/4. If it hits to the major resistance, adding another 1/2. That's basically how I manage my risk for the first red day. And most of the time, if you can recognize momentum shift, you can get in it before the stock is showing the weakness. But if you're for safety issues and you want to make the stock less gamble as possible, so when the stock is starting fading again, that's where you want to take profits on. So after the stock showing weakness, it shows you to confirm the stock is started downtrading, momentum is already shifted, shorting to strength into major resistance. That gives you a higher winning percentage, manage your risk. That's something to keep in mind too, because most of the time pattern doesn't work 100% of the time. So always be thinking what's the worst will happen, and you have to be afford to lose before you enter your positions. So, and if you can't afford to lose, then you're going in really emotional factor in it, and that will make you either go all in or lose even more money. So that's the first red day, a simple version, and I will show a couple examples underneath. This is one of the short after first red day pattern, but you can't just short after first red day for every single stock, because you have to recognize how much profit you can make. That's why you need to track on your plays and how much reward you will get if you short from this point. So as you can see, OPHC, it went from $2 to 14. It faded all the way back to $5. It bounced back to 7. Now this is the first red day. So think about, if the stock coming from $2 and already dropped to 4, so the maximum you can make is $2. Typically stock, it was down 50, 60, 70%, they will always have some kind of bounce. So you don't want to short into this massive weakness and there's not much reward you can get, because the stock started spiking from 3 and the stock ended around a little bit above 4. So the maximum you can get is that $1. and you want to short somewhere it's pretty high, and this is one of the morning spec we're expecting. Why short around this 9 or 10? It doesn't look like I'm looking at the chart already and pointing at this $9 area, because now if you take a look around this November 16th, one spike 14, come back down to 13, come back down. Now it kind of consolidated around this 1.9, which is around this $9 area. And which risk level I'm going to pick? So first, the most consolidation area will be, I will be sizing around the 1/2 because that's the most consolidation. And there's actually a volume trade around that price range. So I'll be taking a short around a little bit above 9. The next point I'm going to short is take another position size around, I would say 11.50, and my ultimate risk is this around 13, because if I'm risking 14, I feel like that's way too much risk for me to take. Now if I added all my positions around 11.50, rest of it around above 9, so my average will be around a little bit over 10 and risking almost 13 level. That's still a little bit too much, because you do want to control your risk percentage under 15%. So never try to risk over 20-30% because the reward is not good enough. Now on this point, you actually need to see how much volume actually traded around November 16th. If it traded around 70 million volume, okay, I will be sizing a little bit bigger because the volume is really big and there's a lot of people are holding around that level. I'm a little bit more confident to short. The heavier the resistance is, the more shorting to spike winning percentage it is. And that's why I'm going to take a short around this 9 to 10-ish level. And when the stock drops under 50% of its own spike, typically that's where I'm going to cover. So the entire spike is from 4 to 10. And if you cut in half, that's where the 50% it is. So typically I want to cover half of your position around $7 area, cover the rest of it if it fades more. So it didn't fade that much, I will cover the rest of my shares around the 7 again. So that will be a $2 gain for me, because shorting into correct resistance and covering at the right point will give me around 20 to 30% gain. MGTI is another first red day short. This is the OTC stocks out of the NASDAQ. The stock dropped from $4 to almost 2.8. And once it started losing momentum, especially on OTC stocks, the stocks typically panics a lot, because in OTC stocks, shares are hard to get executed. So it's really hard to short into strength, cover into weakness. But when they start panicking, short sellers like to chase rather than the NASDAQ. So you can see the stock drop from 4.2 to almost 2.8. And it has the most consolidation resistance in two parts. There's one in 3.5, there's one in the $4 area. When the stock is finished weak, shorting into first red day, you always want to short into strength. And shorting into that 3.35 risk in 350 will be the perfect risk reward to short into. And also you can see a clear support for MGTI, which is around this around 2.6 or 2.7 area. So cover before hits the resistance, cover before hits the support will be a really good risk reward for risking 50 cents to gain 50 cents. That's 1 to 4, 1 to 3 risk ratio. So you can see a clear support, cover right before support. That's the perfect exit. And typically in here for risk reward, I will cover half of my position and cover the rest of it at the end of the day, which is around 320 because it didn't fade. I still took all my profits. I don't know if the stock will finish weak or lower than the support or finish in the mid-range, but my risk is 350. So once I took that half, 2.8, I already made enough profits. So I will let the rest of my shares to run. Either if it's down more, I will make more profits. If it closes around 320, I will still make tiny profits. So in this case, in trading, you can never be greedy. Take what market gives you. Sometimes it's not in your expectations, but you wish to make more. Always be satisfied, and that will keep you away from being emotional. Here's another example of ALDX as a first red day short. The stock went parabolic, and has the most consolidating resistance finished red into the close and finished weak. In first red day, it has to finish weak. You have to short into strength, short into the most consolidating area of the previous day, and the stock has to be overextended. To be overextended, the stock has to be running for a couple of days. How to judge how much resistance you are shorting into? So basically use the total amount of shares and use the total amount of time. If you want to be really precise, you can use those candles at each other together to see how much resistance you are shorting. But basically you give how long has been consolidating in this level and what's the total amount of shares being traded whole day. How many hours has been consolidated, divide by 8 and times the amount of shares you traded intraday. That's how many shares you are shorting intraday. In this case, shorting into first red day didn't work that well. Cover into support is a clear support around 8.5, cover right before support. Sometimes you won't be covered that precise. You want to let the shares to go. And sometimes when I'm only making this tiny amount of money, which is around 60 cents off a $9 share, I will let the stock run further and cover into the close. But in this case, I will likely to cover into the close. I will not be holding into the after hours. If you're holding, sometimes you'll be lucky. The stock might have some kind of bad news. You can cover in there into the weakness and you can make even 50% of original investments. In first red day, always look at the bigger pictures. The stock has to be overextended for days. Has to be consistent consecutively green day to be able to short into. In OPHC, in this case, the market cap is really low. The flow will be lower. If you can see the share amount is 1.1 million, the flow is probably around 800,000 or 700,000. Stock spiked parabolic from 2 to 14. Now you can see the highest volume traded candle is around 160,000. Pull back to half of the spike again failed, and the most consolidation level is around $10 area. Now shorting into the strength and to the first red day, cover when the stock loses half of the spike, cover the rest at the end of the day. Now this is the first red day, as you can see, but you don't want to short into this weakness because the stock spiked from 2 and you're shorting into $4.50. That's not good enough risk reward. So shorting into the strength will be really good in this case, and you can gain from 10 to 7, which is 25 to 30% of your profits. Be really clear. The most consolidation area is your major resistance most of the time, because the more shares being trading into same area, the more back orders you will have. The last pattern is called overextended gap down. Sorry, I'm writing this on the computer, so the drawing is really bad, but as long as you can understand it, that should be good to go. So first, overextended gap down, the psychology behind it is the stock is trading with fresh volume. So the stock has been never traded this much volume before, so you are using the yesterday as an intraday resistance, as a previous day resistance to short into a morning spike. Now stock doesn't have to be gap down, it just has to be showing some kind of consolidating resistance in the previous day. So now what's a normal penny stock chart looks like? Basically, pre-market breakout, breaks over, have its own morning spike, consolidates for the day, and day traders like to take profit before market close. That's at 4 o'clock, and then it's supposed to be like that, 4 o'clock. And to the next day, now either the stock gaps down even more to here and start pushing, you can use this close as your risk level, or the high as your risk level, to short into the spike. Now it just goes down more, or it can spike to the day high, then fading again. So there's gonna be 2 different risk level. So most of the time you can't tell if it's gonna have that kind of big spike or it's gonna spike to where they close at. So you have to split your position size into parts. So first, if the stock didn't not gap down, if it goes straight up, I will typically take one position, 1/3 of my positions before the market open. So around 9:29. Now if the stock shows strength, into the mid-level, I will add another 1/3. And if it hits the yesterday high, I will add another 1/3 of my full positions. So if the stock didn't even spike, I will still be writing profits on the way down. If the stock showed its own spike, either it hits the day high or hit the closing price, I will still be adding and taking profits at the end of the day. So as long as the pattern succeed. Now most of the time, overextended gap down will work if the stock is trading around 20 million shares or plus. I would say 15 million shares or plus. As if you are shorting this, most of the day kind of consolidates. So most of 10 million shares traded around this midday or before market close, and you're shorting, basically you're shorting into a 10 million volume / resistance. Now the higher the volume, the better it is. If you even traded 40 million volume or plus, you will get even better. So the higher the volume traded on the previous day, it will give you a higher winning percentage to short into that potential double top of the morning spike if it either the gaps down or it didn't. So the fourth is higher the volume, higher the winning percentage. Typically, when you want to short into a gap down, you don't want to short when the stock gaps down way too much. That's called chasing into weakness. So for example, the stock previous day spike, consolidates, then 4 o'clock. Now to the next day, if it gaps down like 20, if it gaps down over 15%, I won't suggest it's worth a short before that market open, because you just gap down too much, you're chasing into way too much weakness. And what happens, the stock goes against you and you have that 15% of range to take a loss on. So typically when stock gapping down around 5% to 10%, that's the range I will be shorting before even market open of my 1/4 positions or 1/3 positions. So when the stock is gapping down too much, you don't want to short into that. You only want to short into tiny big gap down and adding into the morning spike, either using day close or the day high. So if the day high and the closing price, the range is way too big, you have to pick which risk you want to risk for, because which place has the higher volume, you want to use that as your risk level. If the stock didn't hit that point, so let's say if you trade a bunch of volume at the market close and trade some volume here, you want to compare if the consolidation volume is higher or the pricing around here underneath and the volume underneath there is higher than the consolidation volume. If it's not, use the day high as your resistance, pick the higher volume. Let's say pick the higher volume to choose either closing price or the day high as a risk. I'll be showing some examples underneath and it will make it more clear. This is one of the patterns still called overextended gap down, but this one was halted around 8 o'clock in the morning. You can see 1.5 at the top, and after once it got halted, I think now some kind of good news for the freeze one. So the stock opened up and started spiking again, and it got huge volume stuffed around this 2 minute volume red bar. That typically means it's really hard to break this red bar. The faster it moves, the bigger the volume is. If it's red, it's hard to break this high again. So once you see this 1.6 got stuffed and try to test this 1.5 again, and you know the volume bar typically around over 2 minute red volume bar, it's hard to break, and you can use this 1.5 again as your resistance to short into it. So if a stock tends to break out and suddenly failed instantly, that's a fake out, and fake out will trap a lot of longs. That's why shorting into this double top will be a good odds, and this is also matches around one of the theory of overextended gap down. This is not a gap down, but overextended gap down uses the second day to risk the previous day top. So we're risking a double top to short into it. And for this ATOS play, this is a really good risk reward. So you're risking this 1.6, this high red volume bar, 1.6 short into 1.4, 1.45. That would be 50 cents of risk to gain almost 60 cents, 70 cents per share. Today I want to talk about momentum shift on today's DPW. Now, if you check around 1 month chart, this stock has run from, I would say, 0.5 into almost $5. Most of the time, $5, it's a round number and people like to short into that area. $5, $10, $20, all those round numbers are heavy shorted area most of the time. I already explained previously, there's multiple ways to play this DPW charts, and if the stock goes against you, you won't be losing that much money. So how to recognize today's momentum shift? First, the stock has been very overextended for last couple of days. And if you take a closer look, week open, start testing this resistance, 4.5, and break through that resistance. And I think in here traded around 30 million shares. Close to the end of the day, traded around, I would say, 50 million resistance. When the stock shows you, confirms and shows you the move, which is around this 4.37 area. So today, most price are traded around this average, I would say around 4.6 area. Once they take out that big support, and I will take in my starting short around this 4.5 area. If it breaks this 4.3, and that will give me a big confirmation of the stock is going down. Because why? Because most of the shares today is traded the most shares of any time, and 70 million shares, which is considered to be once it's momentum loss and starting momentum shift, this high of the resistance will become unbreakable or very unlikely to break for the last month. Taking short here is very safe, risking this major resistance area, and the stock gets halted and start going down and down. And I wouldn't be afraid adding to this bounce because there's so much back orders around that area. So adding here, I would say considered to be very, very safe. The ultimate risk will be probably around this 4.38 area. Initial short will be 4.5. Adding point $4 area. Adding to bounce 3.6, 3.5 area. I would say total average comes out around $4-ish. So risking this 4.3 will be very, very safe entry. Tomorrow, this one will probably go down to the ones, maybe even to the low twos or the high ones. Probably end up around, I would say around $2-ish. So this is my thought process for DPW. If tomorrow pushes, will very likely get stuffed around this $4 area and just going straight down and drop another 30% tomorrow. Almost every single penny stock is a scam. So once their momentum starts shifting, especially on those really big volume shifting, they typically go down 60-70%. I wouldn't be surprised this one end around high 7 or the $2 area. If you're shorting, congratulations. If you're not shorting, if you can't find shares to short, make sure grow your account, get to that trade zero or center point account. So that's my thought process for DPW. This is one of the examples of overextending the gap down. As you can see, the first day after our spike, pre-market spike, consolidated the entire day and traded around this $650 area. I say 60.50 is the major resistance. This close 616 will be red to green, and I will be shorting partial here because I want to risk partial into the close. I will be adding into this 628. So my ultimate risk will be 657. As you can see, stock started pulling back from 6. Most day traders like to see the stock holds red or holds green, so they like to short into risk red to green. Something like this will be the perfect examples for overextending the gap down. The stock went from 2 to 7, very overextended. Now if it doesn't hold here, it should keep fitting into the rest of the day. Overextending gap down, but most of the time it's shorting to strength, shorting to major resistance of previous day. Depends on how many shares traded. They traded around 30 million shares yesterday. That considered to be a heavy resistance. So shorting to heavy resistance, shorting to strength, both bearish factors, shorting to potential lower highs of 2 intraday, that's another bearish factor. So that's why the stock it's likely to go down, and stock typically cuts in half of its gains. So where do you want to normally take profits? It's around right here, 480. If it doesn't drop to 480, you want to find out support. So support is around 440. It's not support around 520. And when it's hit to 520, if you're shorting around 6 or 620, 520 is a step to cover. If it breaks again, another cover point is around 443. So you do want to cover into weakness before hitting the support. So you want to cover a couple cents earlier. Let's draw a line. The first cover will be around here. Second cover will be around here. Hitting 440 is under 50% of its gain, so unlikely to hit, but this 520 is very likely to hit. Another factor is how to choose something that it had really high odds of overextending gap down. First, the stock went from 2 to 550 in the pre-market. As I said, pre-market, anything over 100% and start gapping and start holding, that's called a gap fill strategy because it closed above the open, but it has some kind of weakness after hour and gap down in after the hour. That looks really weird because if the stock can hold its gain all day of the pre-market again, that means the stock has actual strength. So long-term backholders are actually sold, and there's enough dip buyer powers to push the stock and close very strong relative to the open. And that's a really bullish factor. And this is a random drop to the 540. So that's a bullish, and the bearish is conflicting. And today it has a good odds shorting to previous resistance. But yesterday's chart was not as clean as normal overextending gap down. Normal overextending gap down will be pre-market breakout, 20% to 50%. This is 100%, so that doesn't belong to pre-market breakout. 20% to 50% pre-market breakout to maybe 200 to 100%. Then close a little bit weak. Then you can use overextending gap down. Will be really decent odds to short into. But as a short into a pre-market fill using overextended gap down, that's a little bit, there's odds, there's factors that conflict with each other. First, the stock right now looks relatively strong. Second, gap fill is a long strategy. Weak close is short strategy. Holding entire gains is another long strategy. It's a bullish factor. So there's conflict in the factors. When you see conflict and you see a major resistance, your position has to be smaller than it used to be, because the more conflict it has, the less odds the pattern will be succeed. This is one of the examples of PTI. The float is relatively big, and as you can see, the volume is not very high, only traded 1.4 million volume. So when the stock trading 10 million volume, that's a decent volume. You can make stock to keep fading. But if it doesn't trade around 10 million, then stock is unlikely to drop or go up because there's not enough shares exchange. Now let's see if the stock can break, can keep fading. Here we go, 568. Once it breaks 539, that will be a place to take partial profits. And we just need to wait. In here, I want to give some live examples about overextending gap down. Sometimes overextending gap down can be a little bit different. Most of the time, close high the gap down in the morning, and then spike again short. Either you're risking the closing price or risk the previous day high. Now, in this situation, the stock didn't really gap down; it actually perked up. So when you see this kind of afternoon dump at the close, typically when you see a weak open, you can use that dump as your support, dip buy into it. Typically, most of the time, a heavy volume traded stocks will pull up some kind of spike. What's a heavy volume traded stock? I would say anything traded over 25 million shares. This one traded actually over 40 million. So it's having this kind of big push in the morning. But when it started reaching to this 2.66, got stopped up there and started dropping. So my entry point should be around this 2.5 or 2.49-ish area, because I'm only risking 10 cents to making almost $1 a share. And this one's probably going to drop further at the end of the day. Double top for 2 days, it's very deadly. But 2 double top on intraday is not very deadly. You still have chance to break. On one day as a top, or another day they're exactly the same price. Those kind of tops are really deadly. So that's why the stock is just gonna keep dropping. As you can see, 2.29, that's gonna be 2.1. Here we go. I think we'll hit around this $1.8 end of the day. But this is a different version of overextended gap down, but except it's not really gapping down. It's dumped by traded heavy volume, so that's why weak open will show some kind of strength and from another top. So when you are shorting, you don't know it's a double top or it's going to be a breakout. But most likely, if it's traded heavy volume previous day, something like over 25-30 million, the most consolidating resistance should be around here. So 2.24, and the most heavy volume traded space will be around 2.55, and the highest candle in the afternoon will be 2.55. So shorting around here, shorting around 2.45 or 2.47, risking the day high will be a really good risk reward, because there's going to be a lot of backholders didn't expect the stock try to drop in a late day. So this one, and also by judging the parabolic, this is kind of morning spike, but it's kind of parabolic morning spike, except it didn't go really that parabolic. But if you can see, the volume traded over there is the heaviest candle is 560k, another one 500k. So this 2 candles shows you there's about 1 million buying volume over there and got stuffed really hard. So you know here creates another big backholders today, created backholders here, created backholders here. So those are 3 tops that created a bunch of backholders. And when this reaches to that point again, the stock is going to keep dropping, staying very, very thin. And we can see $2 real soon. Here we go, 2.14. No, but I see $2 soon, 2.13. Should I have some kind of bounce over here, because some like right here of yesterday and today some around this $2.2 level, so I have some kind of support. So it should bounce here and keep dropping, but it's unlikely to break at later of the day. Those are really, really popular patterns that happens almost every single week. So keep that in mind and take a full advantage of it. Today let's talk about combining strategies. This is only for short selling. So before we get into combining strategy, we have to review all the short strategies we have gone through. Bounce short, bounce short is something went traded heavy before and stock already went from supernova, and for the next couple of days, if stock bounces back, will be a good short. Now if next time start bounce back again, shorting into lower high into and stock finally dies. That's called bounce short. Second, parabolic short. Parabolic short is when the stock goes massively spiking without any pullbacks, and shorting into strength and shorting into emotional squeeze will give you a good reward of stock coming back down, because there's no buyers and there's too much chasers. Number 3 is pre-market short. Pre-market short is shorting into gap, and this kind of short happens in the morning and only for long-term people trying to get out of their positions and they have consistent volume. So the stock has been trading in this price range for a long time. Once the stock starting gapping up, the first thing they want to do is to sell. So pre-market gap and pre-market short. Number 4 is called shorting into heavy resistance. So the stock is moving sideways, and suddenly there's one day and the stock has been trading in this price range for 2 years, and there's one day the stock has been slowly grinding, rounding up and hitting into this major resistance, and stock comes back down because there's too many people holding their positions at that specific price point, or the fundamental or the technical are not strong enough to break through that resistance. Number 5, which is called overextended gap down, or also we can call the fresh chart, shorting to 2 intraday double top, and the stock is trading fresh charting for 2 days. So stock being overextended, no matter going 100% plus, either it gaps down or not, or it doesn't gap down or it gaps down, and stock morning spike again, hitting into the day high or hitting into the close, whatever your risk point is, stock comes back down. Those are the 5 popular short strategies, and the common combinations you can always find trading into daily market is morning spike plus shorting into heavy resistance. And when you combine the shorting strategies together, it will increase your winning percentage of shorting. So let's give an example. The difference between morning spike happens in the morning. It goes similar like parabolic, but their spiking percentage is under 50%. So we call that a morning spike. And sometimes morning spike can go over 50%, but morning parabolic, we call that a morning spike. Typically, morning spike has more pullback than the midday parabolic, so morning spike means have more pullbacks. Now, morning spike into heavy resistance. For example, on GLBR, I'm going to make some kind of plan for next Monday, and on Sunday, typically on Sunday night, I will look over my watch list and to see if I can make any potential trade into the Monday morning. So on GLBR, it had pushed from 27 cents to $1.5. That's considered to be very, very overextended. And it had some kind of unexpected news, dropped from actually 1.5 to 60 cents. So what happens if this one can pull out a short pattern is called double intraday top, which will have a morning spike into the most consolidating area, which is around 1.22 or 1.3 area. So if you can use that as your major resistance, you're expecting short level, which is around the lowest consolidation area, 1.15, and risking is 1.28. That's typically where my plan is. I won't be going full size shorting into 1.15 and 1.18 because there's a last resistance around this 1.44 area. So I'll be only shorting into 1/2 of my size. If it hits to that 1.44, I'll be shorting into full size. If the stock doesn't reach my expecting point, your size should be a lot smaller. That is my plan to plan for the Monday trade. This is what you need to do almost every single day to see if the stock have multiple reactions, and to predict stock have that, to make a plan, and if the stock making multiple possibilities, if it spikes or if it's just going straight down. So if it's going straight down, I won't be touching anything. If it goes up, that will be my potential shorting into morning spike of same theory as overextended gap down. Now into DCIX. Here are some final suggestions for beginners. After you watch this DVD, before you start getting into trading, you have to study as much as possible and to get multiple mentors to learn their strategies. Second, you have to learn long and short side and the psychology behind it. So you will know what point will make people who are going long stressed or people who are going short stressed. At third, you have to use statistics to track the pattern to see if it actually works. Track the percentage, track the performance, track the average gain, track the average losses, and you will know what exactly you are doing when you go into a trade. Number 4, pick a bias. Typically, you want to be a biased trader. I'm a short biased trader. That doesn't mean you have only go short. You can go long sometimes. but I think being biased will help you to see a stock behavior better, in my personal opinion. And also, you have to go into a trade with a plan. You have to know your specific risk management. You have to know your specific risk point, specific how much money. You have to know your specific risk level. You have to know how much money you are risk at. You have to know what happens and what you will do when the stock goes against your way. Before you get all experienced enough, you have to always start small. Then if you got familiar with the stock pattern and how to control your risk level, getting better with your risk management, then you will become a better trader. And this is another example how to recognize a fresh chart. So before you go in to make any trade, you want to look around this 10-year chart and what is going on for the past years and what's the stock behavior. So typically I only look around this 2 or 3 year chart, but it's helpful to look through what stock has been doing for the past 10 years. So stock has really light volume, and considered to be a light volume, those individual volume bar has to be under 10 million, considered to be light volume. And stock doesn't really have that much volume except this 1 day or 2. So, and the stock is running around this 6 million volume again. At the end of the today, it's gonna definitely run over 4 million as the highest volume. So if the stock is running the highest run ever, trade as a fresh chart. So the chart is completely fresh, there's no history, and you don't know where the resistance and support is except intraday. And intraday resistance and support are not as trustworthy as the long-term resistance and support. The shorter time period it is, the less trust you can put in on the support and resistance. So typically you want the stock to run for a couple of days and to see what the stock does, and you can place your short for 2 intraday double top or 3 intraday triple top. You can use daily resistance and support, previous day or yesterday support and resistance as your actual risking level. If you are using support and resistance intraday, it's unlikely to work most of the time, especially on the first green day. In the 7th pattern, I want to talk about gap up short. This is a really high winning percentage pattern, and it's one of my bread and butter that I started growing my account. So the first criteria you need is stock gapping up over 70%. Number 2, better if they in the history have long-term resistance. So resistance ahead. And on the third part is you need consistent resistance, or if you have individual resistance, that's even better. So you want consistent resistance plus individual resistance. Now, for example, the psychology behind this pattern is for any stocks, if it gaps up over like 300%, and most people cannot trade in the pre-market, once the market opens, the first thing they react to the stock is to sell their position size to get that 300%. So especially on penny stocks in long term is unlikely to succeed in the long run. So once the stock gapping up, typically has really heavy selling volume. And when the short seller comes in, that's even heavier. So stock gapping up 200, let's say over 70%. So long-term investors comes down, and when the chasers start pushing this a little bit, long-term start selling, short sellers start hammering in, that's where the stock goes down. Now, when the stock landing around here is where you take profits. It's the same as parabolic short, but this one happens right after the market opens. So this one typically happens around 9:30 to 10:30, and typically makes those moves really fast because when they try to sell their positions, there's too much selling powers, and that's why stock rarely have stops to bounce. So now for this one, it's better for in the long term has some kind of resistance ahead, because you can use it's some kind of like a bounce short or parabolic short. If you can add gap up short plus bounce short plus parabolic short, the more pattern you can combine together, the higher the winning percentage it is. So if you have some kind of long-term resistance and goes down, gaps up into this resistance, for long-term people who bought and sold here, you have to understand their mentality is the stock has been downtrending for a while. There's one day the stock gaps up like this. It's hitting the resistance. If I can't trade in the pre-market, I'm gonna sell right after market open. That's what I typically will do. So if it's for penny stocks, they drop heavier than typically those stocks that are legitimate has some kind of long-term investment. But for most penny stocks that are completely junk, they drop really deadly. Sometimes stock just to gap up so they can sell their warrants into the retail buyers and make them lose all their money. So first, you also have to check if they have warrants. If they have warrants, either you go into sec.com, search at the market to see if they have any shares to sell anytime into the market hours. If they do gap up really high, that's probably on purpose. Then they're just selling into the buyers and that's make the stock drops where they come from almost 80 to 90% if they have warrants. But if you don't, the stock typically drops under 50%. So what happens if a stock doesn't have a history or overhead resistance? What you will do, typically you don't want to charge in that fast. If the stock is gapping like 300% or plus, you don't know if it can just keep going. So wait and see what happens. So first, when the stock doesn't have the history of resistance, you see the stock gaps up, you see the shares that comes in, and you start pulls back into and start bouncing from the high. So you can use this high as your risk level, and by risking the day high. And because still, no matter it doesn't have or has the history of a resistance, but long-term shareholder will still sell into that massive gap ups. So the odds still favors to the short side. And if you can size it in, find a decent entry to size it in to risk this high of the day, that will give you a great risk reward. Also, the higher it gaps up, the higher the winning percentage it is. And if they have all those bonuses that give to you consistent resistance and individual resistance or resistance overhead, or you can make those bounce short, pair box short, and gap up short together, warrants give you a higher winning percentage. So that's how gap up short works. And always be careful about flow. The lower the flow, if the flow is under 1 million, typically I won't be shorting those gap up short, because that's the lower the flow, the higher it can go. So if it's under 1 million flow or under 2 million flow even, I wouldn't be shorting it. So this is something to keep in mind. Low flow can be really, really dangerous, especially under 1 million, because if you had the experience about DRYS, that happened in 2016 November, you went from 4 to 120 because people just keep shorting it and keep getting squeezed. It's not a gap up short, but low flow under 1 million can be really, really dangerous. So keep that in mind, and I will show some examples about gap up short. Alright, so this is the Dux Ticaret scanner, and what you need to do is, for any scanners, you need a top percent gainer. So that's the only thing you need, and the new heights. Sometimes I use it, sometimes I don't. So basically, you are watching this full like 10, 20 stocks, and you want to select percentage that are over 20%. So that's basically what I look at in the morning. And so those are only 5 stocks. Now I look for green volume. So any volume over 200,000. So this is over 200,000. This is over 200,000. So that leaves me 2 stocks, MYSD and SHLD. So if I took a look of SHLD, now I use market cap and flow to judge if I'm gonna play or not. So I only play market cap under 100 million, flow under 10 million. So under 200 million, I will say that's like the widest range. Now, if I look at MYSZ, this is something I want to look at. Now, a market cap under 200 million, flow under 15 million. So that meets my criteria of my morning scanner. So that is the only place I'm going to be keep my eye on. Now, next thing I want to take a look at is the news. So for Dux Ticaret on the right corner, you can see either it's PR news, either it's global wise news. So basically for penny stocks, if I want to judge the news, so if there's anything doesn't relate to some kind of contract, doesn't relate to some kind of down payment money, that doesn't really consider news. But to keep in mind that's some kind of news. So why did I say NYC is a potential short? Because if you look at the 20-year chart, the recent couple months, they all failed around this 120 area. Failed this 120, failed this 115, failed this 113. Traded pretty big, traded 4 million, traded 3 million, traded 6 million. So 6 plus 3 plus 4, that's 14 million volume. So now the stock is giving up to 110 and giving up to the resistance. And this will become a potential short because it's hitting the resistance of tens of million shares as back orders. So when the market opens, for long-term people who are stuck in those recent spikes, they will sell their positions to break even. And that's the mentality of it. And that's why it's a potential short. Here's some examples of individual resistance. As you can see on ATOS in this November, and you can see in this one green candle, underneath it, 70 million shares traded. So understand the volume underneath and use the individual resistance as your advantage to trade in further patterns I'm going to explain. Also in HTGM, there's another individual resistance. In this one day, traded around 45 million shares. Another day traded around 53 million shares. So the first top was 13, second top was 12. And those two volume bar plus together, they are 98 million resistance traded overall. So that is an unbreakable resistance. So there's 98 million shares traded overall. And to break that volume bar, to break that 13 to 12, it's very, very hard, or it's impossible to break 100 million resistance. And in the bounce, as you can see, every bounce will fail, as I'm going to explain later on, a pattern called bounce short. And to recognize all those individual resistance, go under to the history of volume. The volume bar represents how many back orders are in those stocks. In here, I want to talk about the pump and dump between OTC stocks and NASDAQ and New York Exchange. So typically on those two different, I would say, area, and OTC pump and dump typically doesn't have, it does have some kind of bounce, but the bounce should be very, very weak. So if the stock is overextended, OTC pump and dump can go down most likely 80% to sometimes even 90%, or just get delisted. So on OTC, when the stock is overextended, most of the time they come back down, as long as it's not trading over 100 million volume or plus. Typically comes down half and start bouncing, and then you can use the bounce short, start going down and down and down and down and down. So typically it takes time for NASDAQ to go down. But OTC pump and dump, most likely NASDAQ is not a pump and dump. It's just very, very overextended, and there's a massive volume traded on this specific ticker. Most likely they're really low float. So you also have to focus on where you risk, and also have to focus on where you want to take profits, and what's the average go down point, and you can use that as your next entry, because you don't want to short into here. Because average dropping is around 50%. You don't want to short around 45, there's only 5% you can make, and that's not enough good risk reward, and there's high possibilities can bounce, which will go against your positions. And OTC pump and dump, this pattern specifically works for dip buy. So most pump and dumps, the first panic, so they started trending up, and once they start falling off the cliff, the first panic, you can dip buy, but it has to have some kind of support. So let's focus on one long-term chart. If the stock is a pump and dump, we had the previous spike and start breaking now in supernova. Now if the stock comes back down, there's only one support here, and you can use that as your support to dip buy, because OTC stock tends to drop even more percentage than the NASDAQ. And dip buy using that, OTC stock typically have a decent bounce around 30% to 50%. Then slowly trending down. But there's some kind of OTC stocks, they just go down without any pullbacks, and there's sometimes you have to focus. You don't want to catch into a dead knife, because OTC pump and dump are paid pumps, if they decide to dump all their shares, they can't do that. And if you are catching into dead knives, then you will lose all your money. Now, on Nasdaq, sometimes most likely it's different. If the Nasdaq typically trade more volume than OTC. Now, the average volume of a pump and dump or a very overextended OTC stocks, the volume are between 5 million to 10 million. I have never seen something OTC traded over 20 million shares in one day. So, are unlikely. And if Nasdaq can trade 40 million shares per day, that's very average, like 30 million shares per day, and 100 million shares per day, it's pretty rare. So that's called unbreakable resistance. It's very, very solid resistance, really unlikely to break. So you can use that to size in a little bit more. Now the next thing is, if there's two ways that Nasdaq can lose momentum. Sometimes OTC can lose momentum out of nowhere, just straight go down. So sometimes you have to react really fast. But on Nasdaq, there's two ways that stock can lose momentum. First is the overextended gap down theory. If the stock has been overextended for days, one day start gapping down, and next day start hitting into the yesterday high, forming a double top and start dumping from there. Now that's the one way lose momentum. The second way lose momentum is a failed morning spike. So the stock goes also overextended and suddenly one point lose momentum, start dumping. This one happened on IDXE. I think IDXE is gone, but I will show examples later on. So it dropped from, I think it was from 1.7 to 1.2. Now, most of the time when the Nasdaq stocks drop this much and so heavy volume traded for a couple of days, they will have some kind of bounce. And this pattern also happened on TOPS. I remember TOPS dropped from, it was consolidating around 3 to 3.5 and dropped all the way to the $2 area and started bouncing almost $1 a share. That's 20%. So when the stock is trading heavy volume over plus 20 million or plus, there's always, if the stock loses momentum really quick and dropping like a dead knife, that will be a really point to go dip buy. So Nasdaq dip buy has more higher percentage than OTC dip buy because it's not so manipulated and pumped by the insiders. Let me show examples about TOPS. Now, if the stock was not driven by some kind of offering or bad news, there's most of the time they have some kind of big bounce of the massive panic. Let me see if I can find it. Now, the stock was very, very overextended, traded massive amount of volume, went from $0.5 to $3.5. And when the stock started losing momentum from here, so specifically dropped from $3 area to $2, and you can see there's kind of support on the previous day. So right here 1.8, right here is 1.9 at the round close. So people like to pick round numbers to dip buy, and there's some kind of pre-market support around here too, around 2.06. So if the support is between 1.85 to 2.06, you typically want some kind of round number to dip buy into. That's exactly where they landed. So stock dips for a reason, and people who are behind stocks, and they're human, they're trading the stock by their mindset. So that's why it landed around, people like round numbers. So it bounced from 2 to 2.8. That's almost 30% plus you can gain from. And you can take advantage of both sides. So if you see a massive panic, dip buy, and when typically the stock drops like this and bounced over, will become a potential short. So buy into weakness, short into strength. You can take advantage on both sides. Once the stock trading massive amount of volume and you create some kind of unbreakable resistance, you can start adding shorts into the pops and hold it for a couple of days. You can make almost 90% of its high. So that's the mentality of shorting and dip buying of Nasdaq and OTC. OTC volume was not as good. So if you're dip buying, sometimes can go against your way easier than the Nasdaq goes against you. Second, I want to talk about the maximum squeeze percentage. On this specific patterns typically happens on the second green day, and once the overextended gap down fails and starts taking out the day high, and start going green, will create a massive short squeeze. If there are enough shorts in there, the maximum squeeze percentage is around 60 to 70% before it pulls back and start consolidating. So if you pull a line out, it holds its support, break the yesterday close, start going green, and stock starting squeeze from there. So people like to short around this double top, and starting from here you can use this 0.84 times 60%, then plus 0.85. It should be really close to this 1.23 area. So you have to kind of judge where people are shorting, and you can use that level basically times 60% to judge where's the maximum short squeeze percentage. Typically it works really well, and don't suggest to short into the maximum short percentage, because either the stock dropped and dies from there, or it pulls back. But if you're not calculating really well, sometimes the stock is really low flow, it can go over 70%. So that's something to keep in mind. So if maximum 60% short squeeze, if you can find some kind of resistance in the history and short into that maximum short squeeze percentage, then will be a really good odds of shorting into resistance, and you are adding into this people who got squeezed. After 60%, stocks come back down and start taking another leg up. Before I short into any of these plays, those market cap are way too low. They're under 10 million. It's so easy to manipulate. So be very careful shorting these very low market cap. I would suggest shorting into market cap at least over 20 million, because if it's this kind of low market cap, unless it's going super parabolic, going like 400-300%, and market cap is still under 10 million, then you can take a short on that. But typically short, you want to short something over 20 million. In here, I want to give an example of something not to immediately go short, even though they have a really good resistance. For example, for MARA, as you can see, the stock went supernova from 1 to 17. And the massive consolidation level traded is around 760. Now, as you can see on the long-term chart, the stock has been bouncing back and forth for a while, and the range is around 360 to this 560. And when people want to use that bounce short pattern, they short it from, I would say, 540 today, and the stock is only up 41%. It's at 623. And that's not worth to short. The stock is not up enough for you to short. If the stock is only up 15-20% of a bounce short, and the maximum you can make, which is around 50%, typically 50% of its original spike, that will be 7%. So not worthy to short, because the stock is not up enough, and the bounce short has to be around at least 50% for you to take an entry. Because if the stock is not up enough, even though it has a really good resistance, and short sellers won't be hammered in, so there's not enough short selling powers to short into this MARA. And there's a high chance of the stock can break out this consolidation level, because the stock can be over 30%. So for any kind of stock to increase 30%, especially on low flow stocks, is very possible, even though you have some kind of resistance. Bounce short on this day, and it's possible because most short sellers stuck around 760. Lots of emotional buyers are stuck into it, but the stock has been bouncing back and forth. So the price is kind of neutralized for a while, and the average price is around 480. So if you're shorting around 550, there's only 50 cents you can make. So not up enough for you to short, especially on bounce short. Make sure, be aware of that. You have to always be checking how much the stock is already up, and percentage is somewhat really important. Welcome to the DVD bonus part. In here, I want to talk about how to trade overextension and a fresh chart. So overextension and fresh chart, let me give you two examples. First, when the chart, if it's overextended, the stock is consolidating around a very low number. I would say assume it's $1, and consistently green day, maybe first red day, it turns out it's not the first red day, start overextension again. This is something you typically can find in OTC stocks. You don't typically find in NASDAQ, because in OTC typically trades lower volume than NASDAQ market. So keep that in mind. A fresh chart is the stock is doing nothing but downtrending with really light volume, and there's no heavy individual resistance and consolidating resistance or consistent resistance. So very light volume, and suddenly there's one day the stock released some kind of good news and the stock started spiking again. It's assumed it's over 100%. So in this market, especially in NASDAQ, if you see this kind of chart, and unless the volume is trading over 50 million or plus, I wouldn't be shorting in the first green day. So let me talk about how to trade a fresh chart and it's very overextended. So let's talk about first green day. Now in the first green day, there's typically lots of patterns you can use, like pre-market breakout, meet the perk pattern, and it typically depends on how high of the percentage the stock goes. The higher the percentage of stock goes, the more overextended it is. You can use that to define the stock is overextended. If the stock was running over 100% on the first green day, or maybe 200%, I will put up in my watch list, but I won't be trading as a most potential short. So that's something to keep in mind. That's the first green day. And in the first green day, typically in the afternoon, if it's a trashy stock, and people are afraid of after our pre-market offering, they typically like to sell right before the market close. Now, if it's a pre-market breakout, now unless it goes super parabolic, goes over 400 or 300% plus, that's something you can take advantage of those late day emotional fade, start fading around 3:30 or 3 o'clock, because people doesn't like to hold overnight of potential offering into this massive spike. Now, the next thing I want to talk about is, unless it goes that parabolic, becomes a potential short. But if it goes over 100%, maybe 200%, I'm going to be considering shorting, because I'm considering on the first green day it is bullish. I'm considering to dip buy. If the stock shows significant weakness in the first green day, let's assume the stock had the pre-market breakout, you took advantage of that, start spiking, and had a huge crack in the middle of the day. Now, if the stock tends to come back and break that previous resistance, now it depends on how big of the volume is. The bigger the volume the crack is, the more bearish it is. Especially in the midday, it's really unpredictable. So no matter how big the volume is, that doesn't really matter. What matters is how big is the dip buy volume. So if the dip buy volume is pretty big and come back and break this big soaked red candle with a high red volume, once they start breaking that becomes a potential dip buy or become a potential breakout buy. So that's how you trade the first green day. Now let's go ahead and talk about the second green day. We're talking about overextension. So the chart is very, very clean, and the chart has never had any resistance or support. It is a completely fresh chart. So we're learning how to trade in those first green day, second green day, third green day. I typically trade to the third green day. After that, I stop trading it. You have to see a confirmed momentum break before you're shorting it. And after the third green day, it becomes very overextended, and you don't want to go long on it, because there's potential in penny stock area to lose all your money. So as you can see, if the stocks are breaking out on the first green day, maybe did some kind of midday perk or pre-market breakout, now it closes, or either can finish weak or finish strong. Now the second green day, this is the most pattern can be used in NASDAQ area. It's called overextended gap down, as everybody already heard of. If it gaps down, and you can use that red to green area to short into, or you can use the most consolidating resistance to short into. As I mentioned how to use overextended gap down previously. Now, if the stock hits that red to green area and stock comes back, now there's two choices, because short sellers like to hold their shorts until end of the day because they want to see people panic at end of the day and start selling. If the stock attempts to come back and start closing in green, that's something that you need to very be careful as a short seller. If the stock has the strength and short start covering and to the point is almost green, that's something is really dangerous. It has a really high percentage of gapping up into the next day. Let's assume now gapping up into the third green day. So first green day is a potential dip buy. Second green day, you can use overextended gap down. Now, let's just say in the second green day, the stock did not gap down. Now there's two possibilities. Either it gaps down or it doesn't gap down. So there's the first green day. Now the second green day gaps up. So if the stock gaps up, that shows a really bullish sign. So if people still like to use that red to green area as their support or resistance, especially in your really fresh chart, there is a potential dip buy area into yesterday close or the most consolidating area. If the stock goes pattern like that, you can use the most consolidating area to dip buy as your support and to make a potential gain from there. So this is how to trade either stock gaps up or stock gaps down. Gaps down, use overextended gap down. Gap up, use yesterday close or most consolidation area in the first green day to do a potential dip buy. Now on the third green day, if the stock gains around over 50% or plus and up to the third green day, I should be really careful about what pattern should I choose, because first, if the stock goes consistently 3 days and each day goes over 50% or plus, that's considered very extended. So for most fresh chart, if the stock, let's assume first green day 100% plus, second green day 50% plus, third green day 30% plus, and fourth green day maybe another 70% plus. So when it starts reaching into the third green day like that, that's considered to be very overextended. Now at this point, you don't care the stock either gaps down or gaps up, because you have no idea if the stock can lose its momentum and start going downhill. People like to use the second green day as their support or the first green day as support to dip buy again. So either you didn't see completely momentum loss or heavy volume traded, you cannot short or go long. Go long is more risky than short because the stock is already so overextended. Now let's talk about the volume related to overextension. Typically, you will see a lot of charts that been traded that is very overextended. Let's assume first green day traded around pre-market breakout, midday perk, a little bit selling off, end of the day. That's first green day. Now the volume is very important. Let's assume over 60 million or even 70 million or sometimes 100 million or plus. That's something called massive volume. Now, if the stock was trading this much, typically it needs higher volume into the next day to make the stock go higher. And if the stock trading that much volume and is trading around a consolidation and resistance, if the stock gaps down, there will be a lot of backholders into that consolidation area. So let's assume the stock goes up, consolidates here, and trading around 60 million volume in that day. Understanding there's not many people shorting. Only 10% people are short sellers. 90% people are buyers. So not everybody makes money in that consolidation area. If the stock gaps down, there's a lot of backholders into that area. And let's assume 60 million share traded. There's about 10 million or 15 million backholders up there. Now if the stock that parts again, there will be a lot of selling pressure into that area. So you have to know there's a lot of selling pressure and you can short into strength. But you have to also be careful if the stock comes back again, break that area again, that's considered to be a bullish sign. Very bullish sign, because the stock can break that insane resistance in a very short amount of time. So it's worth to take a go, and I will be suggesting shorting here. But if the volume is that big, it's very unlikely to break through that resistance area again. So that's something to keep in mind. And if you see this kind of big volume on the first green day, I'll be preferred to short into the second green day, or the second either gap up or gap down following day, because I would like to use the previous day support or resistance to make my decisions. And the higher the volume traded, the more back order there will be. So trade all kinds of different stocks. They trade the tickers, they don't trade the specific companies. Once this stock is down, they like to trade the next ticker. If the volume is fading and it's not going to trade as much as volume as previous day, the stock is likely to go down because there's not enough people as the same ratio buy or sell to break the yesterday resistance. That's how you judge volume and overextension. Volume decide how overextended the stock can be. But if the stock is trading insane amount of volume, overextension doesn't go that long. But if the stock is trading around less than 40 million volume on the day, there is a big potential following overextended. There's a big potential following spike into the next day. So let's assume the stock didn't trade that much volume. And into the next day, to break this resistance, it will be really easy. Now, let's assume it's only traded around 5 million volume. The next thing, you only need 5 million volume to really break that yesterday resistance, so you can keep going. You can trade 10 million volume. Now, the third green day can trade 20 million volume. Fourth green can trade 40 million volume. So in the stock market, you can typically see trading 20 million volume on the first green day very, very often. So if you see a 5 million volume on the first green day, there is a potential spike into this following and has a high chance to break the previous resistance. So use the volume and to give you an idea that how many buy holders will be in the stock, and use the volume to judge if the stock is bullish or bearish, because volume is very, very important to trade penny stocks. You can understand the psychology behind it. You can understand where people are holding their shorts, where people are holding their long, and if the stock gaps down, they're nervous, they want to sell and to break even. That's how all the patterns comes together. Use the psychology related to the pattern. Pattern comes from psychology. And if you use statistics to back up your patterns, that will give you a solid idea of a brief structures to be successful in the stock market. Thank you very much.
알랑가 몰라 왜 화끈해야 하는 건지 알랑가 몰라 왜 발끈해야 하는 건지 알랑가 몰라 아리까리하면 까리해 알랑가 몰라 we like party해 있잖아 말이야 이 사람으로 말씀드리자면 말이야 용기 패기 똘끼 멋쟁이 말이야 너가 듣고픈 말 하고픈 게 난데 말이야 Damn girl you so freaking sexy I'm a motherfucker gentleman I'm a motherfucker gentleman I'm a motherfucker gentleman 알랑가 몰라 왜 미끈해야 하는 건지 알랑가 몰라 왜 새끈해야 하는 건지 알랑가 몰라 빨리 와서 난리네 알랑가 몰라 난리 나서 빨리 해 있잖아 말이야 너의 머리 허리 다리 종아리 말이야 Good feeling good 부드럽게 말이야 아주 그냥 헉소리 나게 말이야 Damn girl I'm a party mafia I'm a motherfucker gentleman I'm a motherfucker gentleman. Motherfucker gentleman. Gonna make you sweat, gonna make you wet. You know who I am. Let's say, gonna make you sweat, gonna make you wet. You know who I am. Let's say, I'm a motherfucker gentleman. Motherfucker gentleman. Motherfucker gentleman. Motherfucker gentleman. Motherfucker gentleman.